Get us back to where we don't die from diphtheria in 1 week like members of my family did in about 1905?
I think a huge piece is messaging the process and why it's important. So we need to have all of our politicians come out and talk about why vaccines are important for their children. We can't have this vitriol, this dialogue playing out in the public sphere, and recognizing that scientists have a higher level of training, clinicians have a higher level of training than, the average politician on how vaccines work, why we use them. And so the opinion of an individual in, let's just say, for example, a member of Congress is different than a physician researcher who's trained for 20 plus years to develop these vaccines, roll out the trials, and understand the data on how they work.
Well, Lauren, as we talk about the messaging that vaccines work, what a lot of people see is I'm vaccinated and yet I still have a positive case. And especially as we talk about a new variant now that we're being told evades all immunity, whether you've previously had COVID, whether you're vaccinated, does that just raise the question of getting more boosters into arms? Or is that just essentially saying, look, we have to resign ourselves to the fact that everyone will contract the virus. It's just a matter of how bad it is for them?
Yeah, I think it's honestly somewhere in between. I think we had a few missteps on the science side of potentially talking about sterilizing immunity early in the pandemic, especially since we didn't know exactly how the data would look. And so expecting people to change their viewpoint from I'm going to get this vaccine and I won't need a vaccine and I won't get sick to the vaccine is protecting you, but it's protecting you from getting really sick and possibly ending up in the hospital or dying. And that conversation is continuing to play out. I think eventually, once we get that vaccine level really high in the population, the mild COVID is what we'll start to see. So people will be vaccinated. They'll probably get on a regular vaccine schedule, and it'll feel more like the way we deal with the flu. And to be honest, people get really sick and they die every year from the flu. But research continues on how to make better flu vaccines, how to make universal flu vaccines. And so we'll probably follow that same path.
So what's the appropriate policy response in a world in which people aren't getting as sick, but they still are getting sick? They could still be contagious. Does that mean masks forever? Does that mean we're going to stick with the policy here at Bloomberg where you're out of the office for at least 5 days if you test positive? I mean, how do things have to evolve in that scenario?
Yeah, I think the first step is that we still have to do a lot of work to get our vaccination rate up. So reminding people that they, even if they have gotten vaccinated, that they need to get those boosters, pushing the federal government to bring that fourth dose to people, continuing to do the studies on how we can get into that vaccine cadence and what's most appropriate. Right. And then I think as we grow that natural immunity in the population or that vaccine immunity, we'll see less and less of the masks. But for now, the cases are still quite high. And I think masking, especially indoors, is quite appropriate.
Lauren, are we completely to where this virus is endemic, where it's like, it's here, get over it, it's not moving?
I think it is here, and I do think it is endemic, but we're talking about endemic like it's something we just resign ourselves to and accept, when in reality, we have lots of endemic diseases that we fight tooth and nail to
Give us an example of that.
At bay. So dengue is a great example. Lassa fever is a great example. Maybe not in the United States. We don't talk about them in the same way. But across the world, we fight endemic diseases because they still cause significant morbidity and mortality. And so doing all we can to stop COVID spread and to fight COVID to protect our people is still really important, even if the disease becomes or is endemic.
Lauren Sauer, thank you. Wonderful to hear from you, as always. It's been a while, and that's good news, I guess, but we've missed you. University of Nebraska Medical Center's Lauren Sauer there. I was just getting lost in a new article out by Mohammed Al-Arian out on Bloomberg Opinion, and it is punchy. A long list of what the Federal Reserve needs to do next week to avoid being, quote, remembered by economic historians as having unnecessary caused a U.S. recession, having destabilized the global economy still trying to recover from COVID, having worsened inequality, having fueled unsettling financial stability, and having contributed to debt stress in fragile developing countries. Tom, that's the conclusion of Mohammed's piece out on Bloomberg Opinion this morning.
You know, there's some things I can push against there. It's sort of like the New York Jets. You got to find your evil. But, John, the thing that Dr. Ilarian brings up there that I think says August is EM. I'm watching every morning some of the EM unravelings. You never know how they correlate. You never know what the catalyst is going to be. This is away from the ineptitude of Sri Lanka and major cultural issues there. But, John, on the back end of that essay where he mentions EM, I think he's dead on.
Special coverage of the Federal Reserve next Wednesday will bring you Bloomberg surveillance, the Fed decides. And I'm pleased to announce Mohammed will be joining us, Tom.
I didn't know.
Caught up with him yesterday. That has been confirmed. So look out for Mohammed on Wednesday after
Do I get to ask him a
the
question?
Fed decision. You can talk if you're polite.
Okay, thank you.
That's how these things work, Tom. Futures down 0.2% on the S&P. We're down 7 or 8 points. Your euro weaker. Euro dollar negative 0.6%, and yields in 6 basis points. Down 6 basis points to 281.42 from New York. This is Bloomberg.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
it would take a lot, I think, for the ECB to stop normalizing from where we're at.
The ECB has kind of backed into pretty dangerous territory here and arguably is on the precipice of a policy mistake.
They're hoping they can hike without triggering an even deeper downturn, but that's very much an open question.
I think the risk of the markets is that we talk ourselves into a recession.
The ECB is in an incredibly tough place. All central banks are at the moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Hiking into weakness. That's the ECB right now. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow, together with Katie Lyons. Bramo back next week. Futures negative, 0.25% on the S&P TK. What a messy time for global markets.
Messy time. A lot of news flow coming out here on a Friday. We're supposed to slide into the weekend. We are not. John, you mentioned German yields there as a vote on European confidence. I really wonder how that comes over to what we're going to see next week.
Yields down 20 basis points. There and thereabouts earlier this morning, Tom, off the back of data in Germany and across Europe, which is just not great. It's not terrific. In fact, I'd describe it as pretty poor. Ahead of US PMIs a little bit later. Tom, next week is a massive week for earnings in America. It's not just a Fed decision. We hear from all the big tech heavyweights.
Yeah, we do American Express right now. I think those, I know Kaylee's looking at those. I think those come in with pretty constructive numbers as well. But you're right. Next week is widely anticipated, and boy, I'd take issue, John, with the idea of comparing what we see next week with, say, the carnage of Snap that we saw yesterday afternoon.
Yes, I know. You're not the only one. Kelly Lyons is with you. A little bit. Looking ahead to Facebook and co next week, Kelly.
She's deep into planning crypto Tuesday.
Well, that's always true, Tom. I'm always planning crypto, but I am paying attention to Snap because is that an important macroeconomic indicator as they talk about companies not wanting to spend on online advertising because the environment is deteriorating, and also talking about slowing hiring, something we're hearing more and more companies, especially those in the technology sector, talking about. What does that indicate?
Dan Ives of Wedbush called it a paper plane in a windstorm, and we've got to see how the likes of Facebook and Google stand up next week. I've said that, and I said it earlier as well, Tom, and you seemingly ignored it.
No, I ignored it.
30 minutes ago.
It's okay.
It doesn't count if it comes from you.
It doesn't count.
That's
Okay.
Ives the poet.
It's fantastic. Hopefully we can catch up with them next week. Equities look like this. We're down 1/3% on the S&P. On the Nasdaq, we're down by 0.5%. Yields in 5 or 6 basis points on a 10-year. We've talked a little bit about what's happening in Europe. Not great things. If you're not paying much attention, that's your summary. Euro dollar negative 0.6%, 101.66, and crude down 1.5%. Kelly to 94.91.
Yeah, the unwinding of a lot of the price pressure in the commodities complex, definitely something to keep an eye on, because in theory that reduces some of that headline inflation pressure that we know the Federal Reserve and other central banks are responding to. Speaking of central bank responses, we got a rate cut from the Bank of Russia about an hour and a half ago, or 30 minutes ago. It's Friday. Need to take a break there. But what we actually saw was them cutting rates down to 8%. Economists were expecting them to only cut to 9%. So we saw 150 basis points when we were expecting 50. That brings the cumulative total of rate cuts to 12 percentage points since April. They also said growth isn't going to be down as much this year, and inflation isn't going to be up as much. A very different economic outlook than we thought back in February. And we'll be hearing from the Bank of Russia Governor Elvira Nabiullina at 8 a.m. New York time. Also at 8 a.m. New York time, we're going to be getting results from Twitter. We were just talking about those advertising headwinds. How much is that weighing on this company as well? And of course, there won't be a conference call because they're still in the battle with a legal battle with Elon Musk about that $44 billion takeover. So we'll get the release. We're not going to get much commentary around it. And then finally, at 9:45 a.m. Eastern, we'll get preliminary July PMIs here in the U.S. after those really weak PMIs out of Europe you two were just talking about. And of course, a little bit weaker economic data over the last 2 days than economists have been expecting. Will we get a disappointment on these numbers as well, John?
Kelly, thank you. Given the execution problems, Tom, at Twitter over the last couple of months, is that a paper plane with holes in it in a windstorm right now? I mean, come on.
Complete mystery here. I'm
Can
sure
you get a real
Elon
read
Musk
of
will
what's
tune
happening
in.
there?
No, I don't have a read on that, but what I'm looking at, John, is an absolute confirmation of a travel boom as witnessed through American Express. These are extraordinary numbers with new guidance. Forget about the numbers, John. The real mystery is, what does this travel boom do into the end of the year? To me, that's one of the great mysteries into Q3, Q4.
They see full year revenue up 23 to 25%. They'd previously seen 18 to 20%. The latest from Amex. We'll get you more on that a little bit later this morning. Here's a quote for you. We are at the crossroads between the end of the commodity run and the beginning of the bond market road to recovery. That quote comes from Emily Rowland, and the co-chief investment strategist at John Hancock Investment Management joins us right now. Emily, what do you mean by the bond market road to recovery?
Yeah, clearly, John, we're seeing signs that global economic growth is decelerating at a pretty rapid clip here. Evidence of that over the past few days with economic data. In the U.S., initial claims rising. We saw the Philly Fed just plunging. We're seeing the leading economic indicators barely hanging on at 1% year-over-year growth. And now, of course, this PMI data in Europe confirming that Europe is likely in a recession or very close to one. So we see this broad environment where economic growth is slowing. Now, usually in a late cycle period heading into a recession, bond yields fall. But bond yields have been, as we know, seeing this massive backup over the course of 2022. We think now is the time to lean into high-quality bonds. One hashtag we've been playing around with is buy bonds and chill. You're getting 3 to 5% in high-quality bonds across munis, mortgage-backed securities, treasuries, investment-grade corporates. We would take it right now.
Emily, what is the character of this equity bull market of the last 6 weeks?
Yes, we've seen a couple narratives building that are driving this. I think certainly the breather that the dollar's taking. We all know that a stronger dollar can crimp corporate profits. The dollar coming back a little bit. There's also a narrative building that we've reached, maximum capitulation here, meaning that any seller that wants to get out has gotten out. And we would be really careful with that narrative. There's a few kind of things that usually happen when you can start to call for a more durable bottom. High yield bond spreads. We're at 489 basis points right now. They've got to blow out a lot more. Earnings estimates, yes, they're plateauing. Yes, they're leveling off. We want to look for those to actually roll over. And then finally, we have to actually have the recession. There's a lot of markets that are pricing in a recession, but we still have unemployment at 3.6%. We still have consumer spending pretty elevated here. We have to experience the recession before we can call for a more durable bottom. So we would be careful here about leaning into this rally.
Okay, Emily, just on the subject of earnings, because obviously it's a big week for those next week. The bulk of the market cap of the S&P 500 will be reporting. Is what you're saying that there is still too much optimism out there on corporate profits?
Yeah, when we look at estimates for 2022 earnings growth, they're still at just over 10%. And we think that that's likely overly optimistic. We're looking for low single-digit growth here. Not terrible. The bar is pretty low. There's a lot of pessimism around earnings. But what companies are doing right now is they're finding every lever they can in order to generate cash flow. So we do see this deceleration in economic growth starting to hurt corporate earnings. Look, the tightening that the Fed has put into the system still needs to be felt by corporations, and we still think that there's some room to go there. We do think, though, that leaning into higher quality companies, ones with great cash flow, good return on equity, lots of cash on their balance sheet, that is what you want to do in a late cycle period. And frankly, quality has gotten crushed this year. I don't really understand why. We're starting to see a rotation into it. That's where we would lean into for the back half of the year.
Emily, one final question from me. Is Europe investable in 2022?
Good question.
Yeah, I think you've got to be real careful there. Growth clearly slowing. Earnings estimates are rolling over. We think getting very defensive in Europe, owning quality, embracing areas like utilities, infrastructure, healthcare, staying away, because from an index construction standpoint, if you own Europe, you own cyclicality, you own economic sensitivity, not what you want to own in a recession.
Emily Rowland of John Hancock. Emily, thank you. Tough moment for Europe. We've said that. Put it on repeat. You can clip it, Tom. I'm going to say it 1,000 more times through the summer for this ECB before they meet again in September.
Yeah, Nestle in U.S. dollars down 14% from the peak, just to give you an idea. I guess it's pretty good. But again, it's a boring food stock. It's not like a tech play. But nevertheless, I agree on Europe. It's a mystery, but I don't pretend to any expertise there, John. I think we really need to catch up with David Harrow. Just as one example on
Agreed.
European
on the banks, Tom?
Yeah.
Without a doubt.
I think we need to catch up with David, and we can do that. I mean, we were supposed to be in Frankfurt yesterday. If we go for the next meeting, it'd be great to have David Harrow along.
You want to do that? You want to go in September? We could spend the whole of September in Europe, Tom, given the Italian election is taking place around that time too.
I think we could do that.
We've just put out a survey, Tom, of 44 economists that Bloomberg conducted on where the Fed peak's going to be. They've got it at 375 early next year. and then a pause before cutting rates before the end of the year.
Do you know how great this is? The interns come in on Friday. I mean, years ago, the interns never showed up on Friday.
They actually come in on a Friday? Why are you saying that? Why are you mentioning that?
No, I just think it's great that the interns come in on Friday. They're here this early. It's good. They're hungover, but hey, you know.
Is there a reason you mentioned that in response to what I just said about Fed funds peaking at
No, I'm sorry, John.
Just ignore it.
Once again, I wasn't paying attention.
Okay, thank you. That means a lot, Tom. Let's go through the price action.
Please, let's save ourselves with a data check.
Kelly and I just have a chat.
Okay.
Futures down by a third of 1%. Let's call it that. On the S&P. It sounds like you've had a few tanks already. On the Nasdaq, we're down about a half of 1%. Yields in 5 or 6 basis points. Kaylee, if you wake up this morning and you wanted to be pointed towards one piece of price action, I wouldn't say snap. I'd say look to German bunds. Look to the German bund market. And what is that telling you right now?
It's telling you that the ECB just hiked 50 basis points and got to zero at a time of a very dire economic outlook for Europe. The PMI's contraction territory on the composite in Germany, manufacturing and services are there. And it's not just when it comes to bunds. BTP yields down 19 basis points on the 10-year right now.
Down 20 basis points on a 2-year bund. On a 10-year, we're down 16 or 17. Back to 42 basis points at the front end.
Italy, Germany, I mean, I'm sorry, it has not come in. It is still severe.
Well, it's off the wides of yesterday. Let's be clear about that, without a doubt. And the fact that Italian yields are actually coming in today is a positive, Tom.
Yeah.
The problem is that the epicenter of all this price action is just really weak European economic data. Really weak.
John, the epicenter of Italian price action is Gucci at the bottom of the Spanish stairs.
You're very distracted right now,
Yeah,
aren't you? I can
He's shopping
tell.
for
That's the
loafers.
epicenter.
Are you doing online shopping for Gucci
It's
and
not on,
airlines?
Kaylee, it's not online shopping.
What's a worse macro indicator of what's happening right now?
How busy
Snapchat or Tom spending?
No, come on.
Which one?
As we discussed yesterday with Francine, the number of chairs empty at the Hassler Bar, that is a major indicator.
From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. U.S. social media giants are on track to lose $69 billion since yesterday's close. Disappointing revenue from the parent of Snapchat raised concerns about the outlook for online advertising for the whole sector. Snap sees a major slowdown in the ad industry, and the company is planning what it calls a substantially reduced rate of hiring. Commerce Secretary Gina Raimondo warns that the U.S. can't keep relying on Taiwan for semiconductors. In a virtual speech to the annual Aspen Security Forum, Raimondo said Congress needs to pass legislation to support the domestic production of high-end computer chips. She called the $50 billion package, quote, a Sputnik moment for America. And there is another sign that a recession may be on the horizon in the euro area. Private sector activity in the region unexpectedly shrank this month for the first time since the pandemic lockdowns of early 2021. A survey of purchasing managers by S&P Global dropped to a 17-month low. Manufacturing output fell and service sector growth almost stalled. In the UK, a new poll shows Foreign Secretary Liz Truss extending her lead over former Chancellor Rishi Sunak in the race to become the next Prime Minister. According to a YouGov survey of Conservative Party members, 62% said they would vote for Truss and 38% went for Sunak. An earlier poll this week had Truss leading by 19 points. And Turkey says an agreement to allow shipments of Ukraine's grain will be signed today in Istanbul. Ukraine, Russia and the UN will sign the accord. Ukraine's grain shipments have been largely stalled as its ports have been blocked since the Russian invasion. That's led to predictions of an increase in world hunger. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think that it's important for us to show support for Taiwan. I also think that none of us has ever said we're for independence when it comes to Taiwan. That's up to Taiwan to decide.
That was Nancy Pelosi, the US Speaker of the House there. From New York City this morning, good morning. Futures are negative, 1/3% on the S&P. On the NASDAQ, we're down by 0.5%. This from Mohamed Al-Arian this morning on the Fed. It seems to remain the central bank in advanced economies that is most prone to, using a phrase from the former Chancellor of the Exchequer, Rishi Sunak, fairy tale economics, and it is the most systemically important of all these central banks. Mohammed, fiery this morning, Tom, going into the Fed next week.
Yeah, it's an important essay, and it's something we'll play off of here, not only today, but through the weekend and into next week as well. I think, John, we really have to set up the Fed meeting next week. I have to admit it's a different meeting now after the desperation we saw from the ECB yesterday.
75 basis points seems to be the story, Tom, but you know what? Maybe we wake up on Monday to another article that tells us it's 50 or 100. I've got no idea.
That's a parlor game.
I'm not bitter about it at all, am I?
Yeah, well, I'm looking at German yield right now.
Hey, Tom, finally, thank you.
And
you're getting on board this morning.
Well, no, I don't want to go that
He executed his online shopping
purchase. Kelly, it took an hour and 20 minutes for Tom to log into the terminal and have a look at where buns were.
Yeah, but the problem with that, John, is John, I didn't darken the door till 5:54, so that was the real problem there. This is a personal note, and it has to do with the courage of Lee Zeldin, who is a Republican candidate for governor of New York, where he was accosted yesterday in New York, in Western New York. I have a major acquaintance with. We used to measure the size of a Jenny Cream Ale by the size of the beverage at whichever bar we were showing our illegal driver's license to. And the best place in Fairport, New York was the VFW. And we would literally say, let's go have a VFW, and fancy brats like me would hang out with the middle class of Fairport, New York, this along the Erie Canal. Joe Matthew joins us now on the summer of discontent for our middle class. Joe, I don't even know the details of the attack on the candidate for Republican governor in New York. Yeah. He is safe. That is fine. But what we do have is a summer of middle class discontent. How does Washington play that?
Well, I'll tell you, Adam Kinzinger, I guess, was correct when he said that there is more violence coming. This is a terrifying moment here, and I'm glad you brought it up, Tom. It's not getting enough attention. This guy tried to stab Mr. Zeldin on stage, and Zeldin took care of himself. He managed to grab the guy's wrist before people could actually jump on him, and he is all right. But is this the new world that we're living in here when, my goodness, after what we saw with Shinzo Abe following January 6th,
right?
This is not a business for the faint of heart. And based on what we're seeing here in the January 6th committee, there are a lot of things that you might not want to know that happened that day.
Joe, partition how the Democrats and the Republicans each have a different middle class. What is that distinction between Speaker Pelosi's middle class and former President Trump's middle class?
Well, it's interesting. It's a great question. It drives the conversation in two different ways. The Democratic middle class, at least through the eyes of Speaker Pelosi, and by the way, Joe Biden, who talks about, when he was growing up and his dad said the middle class just needs a little bit of breathing room. We hear that refrain a lot. They think that the progressive Build Back Better agenda is, in fact, what's needed here. Child tax credits and so forth, that they're not getting lower prescription drug prices. The Republican middle class says no. In many cases, let's bring back Donald Trump and get back to growth here, get back to tax cuts. And that's going to be the conversation that people will need to use to decide when they go to the polls in November.
Well, speaking of conversations that have lasted a very long time, Joe, Build Back Better is something we've been talking about for how long? As
long as we've known each other, Kaylee.
Does it even exist anymore? I mean, it just seems like little fragments of what the initial legislation was intended to be.
Well, that's true. It's going to be a shadow of, well, I won't say its former self because it never really existed. The massive $2 trillion plan that never got through Congress late last year is going to be much smaller. And based on what we're hearing from Joe Manchin, will be very deliberate. The prescription drug component will be in there. And also, I've said this before, keep an eye out. No one is talking about it. For expanded subsidies, enhanced subsidies for Obamacare that were put in place during COVID. They expire at the end of the year. Until now, there's been no plan for Democrats to extend them, and they want to use that reconciliation bill, call it Build Back Better Light or whatever you want, as an opportunity to put that in there. Now that we have a president with COVID, by the way, there's still the matter of COVID funding as well. $10 to $20 billion requested over 6 months ago, still has not seen the light of day. We were told by the White House therapeutics would start running out by now, and by September, vaccines will start running out if this isn't handled.
Well, to that point, Joe, Biden campaigned in part on getting the pandemic under control,
That's
even
right.
if it isn't as severe, which is evidenced by the fact that we are treating President Biden's COVID case very differently than we treated President Trump's in October 2020. Is the White House kind of putting that on the back burner? I mean, it doesn't seem like there's any effort toward getting people vaccinated and boosted. The conversation about it largely seems to have just faded into the background.
Well, they did take the opportunity yesterday to say, look, the president is not in the hospital because he's fully vaccinated. They did urge people, particularly those over 50, if you don't have the vaccine, go out and get it now. It is extremely important. But the why is what's changing. 1 year ago in a CNN town hall, President Biden said these vaccines will keep you from getting COVID. Yesterday, it was clear that that was no longer the case. And in fact, people who get vaccines could still be infected, and they said everyone at some point will. It's just that your symptoms will be lower. That's going to be the message from the White House here going forward. It's a lot different than where we were a year ago.
Hey, Joe, good to catch up as always. Joe Matthew there down in D.C. We've got to get back to this bond market in Germany. We're down 24 basis points on a 2-year yield. The attention's here because of what's happened with the economic data out of Germany and the energy issue as well. When the PMIs come out, the dividing line between contraction and expansion, it's 50. We got sub 50 out of Germany today. The composite at 48. Tom, a 48 handle on the PMI.
I agree in the movement here on a 2-year yield from a 0.77 to a 0.43. The word is precipitous. John, I keep saying this, and I felt it yesterday with the lengthy ECB conference that we took, and that is there's a war going on. And I think we're all struggling with the fact we're distant from the war. We're on war footing in Europe, and we shouldn't be surprised by these economic shocks.
And for that reason, Tom, a lot of this is unforecastable. On top of that, how do you price in a rate hiking cycle with that in mind?
You don't.
So the euro's weaker and the 2-year yield is much lower off the back of this. I mean, we're looking at the biggest one-day drop on a 2-year. The headline crossed earlier since 2008. It's
Yeah,
a
well,
big move, Tom.
And what if we break through to these new levels of negative rates, whatever? What does Euro do? And you had the Kit Jukes thing. You were putting something out on Twitter, John, when I was just getting into the office.
Unviable, his word,
yeah,
Tom.
Yeah, it's important.
Coming up, Terry Wiseman's going to join us from Macquarie on this mess in Europe. From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Three-day winning streak on the S&P 500 into Friday. This Friday morning, we're negative 0.25% on the S&P. We came very close to 4K at the close just yesterday on the S&P 500. We're pulling back just a touch, down 0.4% on the Nasdaq. Snap numbers, awful. Kaylee's going to go through them for you. In about 30 minutes, we get Twitter, Tom. So I know you're super excited to hear from Twitter.
I'm way on top of Twitter.
As well. I'll get to the bond market
Maybe they sold some Bitcoin.
Go to Treasuries, 2s, 10s, and 30s. You want to talk about Tesla too? Your 2-year comes in 7 or 8 basis points. Your 10-year down 7 basis points. This is really defensive stuff, and arguably not just off the back of the recent economic data out of America, but also off the back of the economic data in Europe too this morning. Take a look at Germany. Your 2-year yield is down 25 basis points on a 2-year yield. Think about that. The why. The data in Europe is just bad. Sub 50 on a PMI, Tom, that's contraction territory. That's why you're seeing German yields plummet, why you're seeing a euro weaker again and getting back to 101.
They don't have an NBER. I wonder how they figure out recession over there. I honestly don't know the answer to that, John.
The market will do the maths for them, Tom.
Exactly.
The numbers don't look good.
Yeah.
And we've got to figure out the incoming data and what it means for upcoming policy meetings. I know you want to go to the next Frankfurt meeting in Germany, Tom. I think we also need to work out
we need
the
to
number
go to
one
the
issue.
Bank of France meeting.
Tom, the number one issue is the gas flowing from Russia into Europe.
Yes.
And right now you can't forecast that. But what I need to understand, and I think what we all need to understand, Tom, is how the ECB will react to that if we do get a negative supply shock on energy in Europe this year. How do they react to higher energy prices if they're worried about second round effects? Do they just keep hiking into economic weakness, Tom, or is there a tipping point later this year?
They are a central bank that will adapt to a war footing. That's what they're talking about now. Ambrose Evans Pritchard in the Telegraph talked about how the United Kingdom has to figure out a war footing like Europe. They're all trying to do it. I mean, there's a war going on. The epsilon in the equation goes to the moon.
Tom, we're on the same page.
We are?
We are. Of course, there is a war going on. That's undeniable. Wow. We're on the same page. Tom, what I keep stating, though, is what we've got to figure out is what happens if that gas gets shut off. How does the ECB respond to that? We need to work that out, Tom. We need to establish the reaction function of a given central bank to work out what the data means. You can't just say you're data dependent, we go meeting by meeting, and then the market tries to figure it out and can't because the ECB gets to pick and choose every other meeting, Tom, and then comes out a few days before with a newspaper article and says, we'll go 50. That's not how this is meant to work. It's not how it's meant to work at all. Your euro right now, weaker by 0.7%. Let's across asset price action. Let's get you some single names, a little bit of Snap, some Twitter. Tom can't wait. It's Kelly Lyons.
Yeah, a lot of Snap, or at least a lot of downside for Snap. Remember, this is a stock that was down 70% ahead of its earnings results, and after the fact, it's down another 30% in pre-market trading. Absolutely brutal as the revenue disappoints due to a slowdown in online advertising spending because of the deteriorating macroeconomic environment. And of course, in theory, that has a read-through to other companies dependent on that online ad revenue. The likes of Pinterest down 6%. Meta is lower. Alphabet is lower. Of course, both of those companies reporting next week and reporting later on this morning in less than half an hour. Twitter, it also is down 2.5%. How much do we see similar advertising trends affecting them? But of course, there's a lot of noise with that one because of Elon Musk's takeover, maybe not, of that company. There are some other earnings movers related as well that are seeing pretty big declines. Intuitive Surgical missing on the top and bottom line. Actually, the biggest revenue miss on a percentage basis going all the way back to 2013. It's down 12%, as is Seagate, the big computer company. It's down about 12% after his forecast disappointed, citing a weaker economic outlook. One positive story out there, though, and this is interesting because we're talking about weak economics on one side, American Express raising its full-year revenue growth outlook to up to 25%. It previously thought it would only get up 20%. And when you look at the numbers in the quarter just reported, record spending on the part of American Express customers, volumes up 30%. Now, of course, part of that is because prices are just higher. People are still spending. Of course, they're using leverage to do so, but a very interesting conversation to have as American Express rises about 4% in pre-market trading, Tom.
Thank you, Kaylee Lyons. Greatly appreciate that. Right now, this is a joy, incredibly well-timed. Thierry Weisman joins us, global interest rates and currency strategist at Macquarie. Thierry, I know John really wants to focus on Europe, and yes, that is front and center now, but I've got to go back to what you and I did years ago, which is the unraveling of currencies that we see in EMFX, particularly the Pacific Rim, Indonesia, Myanmar, Malaysia, and the rest of them. Are we hearkening back to another August of long ago?
Look, the emerging markets are not really, a blob, Tom. It's not as if Brazil has the same dynamics, let's say, as in Indonesia, as in China. There's a lot of variation in the emerging markets, especially with regard to what they depend on for their terms of trade, where they get funding from. I hate to overly generalize about them. I can tell you, however, that, with commodity prices now sliding, which is a very different situation that we had in the first quarter of this year when they were generally rising on the back of the premise that the war would drive commodity prices up or that a recovery would drive commodity prices up. I am concerned about those emerging markets that are overly dependent on commodity prices to support their terms of trade. Brazil, for example, Colombia, Chile to some extent, and some of the Southeast Asian markets that you mentioned, South Africa as well. But if we're talking about those emerging markets that are not overly dependent on commodities, China, for example, then I'm not too concerned. We have to make a distinction between those emerging markets that are commodity dependent and those that are not.
Terry, let's swing over to Germany. John has been focused here on the collapse that we see in yields today in Germany, economic contraction amid a war. How do you synthesize the uncertainty of a war in Ukraine across the economics and the finance of Europe?
I think the gravest concern right now, Tom, is the one you guys were talking about earlier, which is the prospect that we will see rationing in electricity in Europe if we do not get the natural gas flows restarted. There's another problem in Europe, of course, which is climate resiliency, which is also eating into their reserves of natural gas. We may be facing a situation where in the winter we just don't have enough natural gas, but politicians and policymakers will anticipate that and ration well ahead. In fact, that could start anytime. I think to the extent that the weakness in the PMIs was so significant in July, it's because these companies are concerned that they will not have the electricity to produce. And if they don't, what's the point of ordering machinery if you're not going to be able to run them in the next few months? That's the gravest concern. With regard to how the ECB handles that, it's anyone's guess. But I also agree with you that they were too ambiguous in the communications yesterday with respect to what kind of data they're going to be watching. And I think the weakness that we're seeing in the euro this morning has to do a lot with the fact that there's ambiguity with respect to what the ECB is watching.
We are clueless as to what their reaction function is.
That's absolutely right.
That's the problem. And with that in mind, it gets very, very difficult to buy the euro. That's their problem too, because that means weaker inflation. SocGen's Kit Juice came out this morning and said it was still unbuyable, potentially through the rest of this year. Terry, do you share that view?
I do. I mean, if we're looking for those triggers that are going to create escape velocity for the euro, we just don't see where they are short of a diplomatic solution to the war, because the war has so much to do with European growth right now, especially through the prospect of electricity rationing and the implications it's going to have on industry. Look, if they ration, they're going to ration industry. They're not going to ration households. That would be a political disaster. They'll shut down factories. They'll have them running 4 days a week instead of 5. That's the scenario that will hang over this market until we get clarity and resolution on the natural gas flows, and that's presumably dependent on a resolution to this war.
Terry, I tried very hard to listen to every word that Christine Lagarde said in the press conference yesterday, and there were just very few things that I felt were worth transcribing quotes from her. One of them being, "We are moving in one go to zero. Does that mean we are changing the terminal rate at which we want to arrive? No." Then a couple of seconds later, she goes on to say, "What is the neutral setting? At this point in time, I don't know." Terry, do you know? Do we have a real understanding of how high the ECB is actually going to be able to hike rates, given everything you've just laid out for us?
Our own economists think that we could get a terminal rate that's above 1 sometime in the early part of next year. We're starting to have our doubts, though, right? The reason has to do, again, with the prospect that if we get an electricity rationing in Europe, we're going to see much lower growth in the second half of this year. It's effectively the road to ruin. On top of that, of course, you have stress on the Italian BTP market coming from too many speculators who think that they should make a speculative attack on Italian bonds. Those two things, I think, have the capacity to deter the ECB from going all the way up to 1.25%, let's say, by the beginning of next year. I think that what Christine Lagarde was trying to say when she invoked the idea that they're data dependent and month to month is exactly that they just do not know how they're going to respond to a situation where inflation continues to go up, but you have financial stresses in the credit markets at the same time that you have a collapse in sentiment and the outlook for new orders continues to deteriorate.
Terry, you nailed it. They're data dependent, except they don't know how they're going to respond to the data.
That's right.
Terry Weissman of Macquarie, thank you. And Tom, that's the difficulty we've all got with this ECB right now.
Yeah, there's no question about it. I mean, and the ambiguity is the word there. I think ambiguity, and not only the English part of it, but the economic part of the use of the word ambiguity really plays it out,
Sure.
John. And again, the German yield is a precursor for just a simple observation. When and how does euro break 1.0167 and revisit below parity?
It's just odd to see these kind of moves on 24 hours after the Hawks took control of the ECB, where it seems like they basically turned around and said you can have your TPI tool dripping in mystery and ambiguity.
And they get 50 beeps.
And we'll have 50 basis points, and let's try and do that again in September.
The markets go right again to September and model that out. I can't emphasize enough, John, how the look back that we do is just wrong. They're always driving forward.
Tom, I can't emphasize enough that some of this weakness you see in the euro, it's not just about the economic data. It's also because there is such a lack of understanding about how this ECB is going to respond to that data. Biggest risk factor this year for Europe is that the gas gets turned off from Russia into Europe, and we don't know how they'll respond to it. That's tough. The euro's weaker, yields are lowered by 8 basis points on a 10-year, in Germany much more so. Futures are down by just 0.2%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Trump insiders told the January 6th committee the former president ignored pleas to call off the mob storming the U.S. Capitol. The panel held a televised primetime hearing Thursday night. Members cast the former president's inaction as a desperate final ploy in his struggle to hold on to the presidency. And the White House is confident that President Biden will avoid the worst of the coronavirus thanks to vaccines and a therapeutic drug. The president is experiencing mild symptoms and has begun taking Pfizer's Paxlovid. He will isolate at the White House whilst continuing his duties. Authorities and lawmakers in Taiwan are said to be hurt and confused by developments in Washington over a possible visit by House Speaker Nancy Pelosi. It would be the first by a House Speaker to Taiwan since 1997. President Biden says the U.S. military doesn't think it's a good idea. China has warned Pelosi against going to Taiwan, which Beijing claims as part of its territory. And in New York State, the Republican candidate for governor was attacked at a campaign event. Officials say a man with a pointed weapon tried to drag Congressman Lee Zeldin to the ground before being subdued. No one was hurt. The attack took place outside the city of Rochester. And American Express posted second quarter revenue that soared 31% to a record. That led the company to raise its forecast for full-year revenue. Amex customers kept spending on travel despite mass cancellations and long waits at the airports. Meanwhile, the company's expenses rose more than expected, 32%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Currently, there's at least a trickle of gas supply going through Nord Stream 1, but we never know whether or not this is going to be continue for several months. In Europe, basically, the border between stagnation and a proper significant recession is whether or not we still have access to Russian gas.
It is one of the biggest risk factors into the second half for the European economy. That was Jill Moak there, the chief economist at AXA Investment Management from New York this morning. Good morning. Here's your equity market. We're down 1/10% on the S&P. On the Nasdaq 100, down by about 1/3%. Yields in by 8 basis points now. It's a break your 280 on a 10-year in America, 279.77, and it's a big break lower in German yields off the back of what's happening, Tom, with that economic data. And as Jill Moak said, Nord Stream 1 is back online, running at 40% capacity, relatively speaking, compared to the news of this week. That's better than expected, but the risk factor is this could come down to 20%, Tom, in the next couple of weeks.
Yeah, yen with the big move against euro. I'm going to say euro hasn't broken yet. I'd watch that, John, in the next coming hours.
Yeah, down 0.6 to 1%, 101.69.
Right now in oil, Julian Lee joins us, and of course this has to do with Germany as well. Oil strategist at Bloomberg. John Farrell, Julian Lee particularly is focused on this. As you read into the weekend, what is the distinction in the Nord Stream debate, in the turbine debate, in the pushing of hydrocarbons across great distances debate? What's the distinction you're studying?
I think the thing that I'm looking at the moment is sort of the levers of uncertainty that President Putin is wielding, and that is on again, off again gas supplies through Nord Stream. Will they keep up at this current level of 40%? Will they go down again? Will he start messing around with crude oil exports? We're certainly seeing, crude being shipped much longer distances than it was in the past. But we are seeing, while we're seeing Russian flows going to Asia, we are seeing compensating flows coming in the opposite direction as well. And I think the big thing with oil at the moment, at least, is weighing up the demand side uncertainties. COVID coming back again in China, uncertainty over European economic growth, against the supply uncertainties around Russia, and will the OPEC plus countries agree to further output increases? They meet at the beginning of August. Eyes are going to start focusing on that perhaps next week.
Julian, just as far as the European gas consumption is concerned, what's the latest on the voluntary demand cuts that were floated early this week?
Well, I mean, they're still out there. There's clearly a need for this. I mean, whatever happens with Russian gas flows, Europe is going to have to get its gas consumption down, and I think that's going to be the UK as much as continental Europe. And the sooner we start doing that collectively, the less severe the cuts are going to have to be. If you know, we keep burning gas at the current rate right up until the start of winter, then I think things are going to get very tricky as the temperatures get colder. So the sooner we start curtailing gas consumption, the less deep we're going to have to make those cuts.
Off the subject of gas, onto the subject of oil, Julian, I'm just taking a look at WTI prices down some 18% since their peak just last month. I mean, we have seen a massive cooling in the oil market. Obviously, a lot of the conversation shifting to a potential cooling in demand if the economy is slowing. And yet, I know that earlier this week, you put out an opinion piece that says if we're lucky, OPEC is wrong about its demand forecast because we're still not going to have enough supply to meet it. Is the market getting the supply and demand balance wrong?
I think there's a number of things that either the market isn't fully getting right, or perhaps the forecasters aren't getting right. I mean, if you look at the OPEC forecast, which is what I was talking about in my column, they're talking about 2.7 million barrels a day of demand growth next year, and an incremental requirement for crude from OPEC of about 1.4 million barrels a day from where they are now. That's going to be very difficult for them to do, I think, given capacity limitations. But the other big concern, I think this is a concern that the US Treasury has, is that the market isn't fully pricing in the potential impact of EU sanctions on Russian oil, and in particular, the upcoming ban on insurance on tankers carrying that crude, which they say could push prices up significantly.
Julian, no one's watching in America on a Friday morning, so let's go buy, hold, sell. What's your view on oil out 6 months or a year? We've got one group up, and away. We got another group going, maybe not. What is it?
Well, I mean, I hesitate to try and call it even a month ahead, let alone 6. My feeling is that if you buy into the up narrative, you're very quickly going to find yourself on the down narrative, because as oil prices rise, I think that is going to put much more pressure on the economy, as it has every other time that we've seen oil, you know, getting up above $120 a barrel. So I think if oil does go up, it's probably not sustainable.
Julian, awesome to hear from you. Julian Lee there out of
Julian.
London on the energy situation. Just one more thing on London for a lot of people who might be interested in this. British Airways have just avoided another strike, Tom, potentially taking place. They've avoided that, and they've come to a deal with that one union.
Well, what do you think? You're more up to speed.
Do you want the new
Are they
pay
getting
deal,
their act
Tom?
together?
They're getting an 8% pay rise, a one-off bonus, and a reinstatement of shift pay. And it was backed by 75% of workers, that according to Sky News moments ago.
Well, the thing I don't understand, if the planes are jammed and they're getting what they're getting revenues, right?
Yes.
So
can the airport service what the airline wants to do, though? Seems to be the tricky part.
Yeah, that seems to be the point. John, what I've learned, I learned something new every day, folks, and I really have to say, given this week of tumult, our team has been outstanding. The bookings have been better than good, and just some really, really good work. John, on the break, I had no idea Boston beer was a future Dow component because of this thing called seltzer and hard seltzer. John, have you ever had one?
Sure. What's it called, Katie? White Claw?
Theirs isn't White Claw. Theirs is Truly, which in my
sure,
personal
but hard
opinion
seltzer is White Claw, yeah? White Claw is hard seltzer.
Same
not
category.
A fan. Not a fan.
It's fizzled.
Cowan said that the hard seltzer category is still murky, Tom. That's the latest on that front. The stock's down 9%.
Well, the stock's down 74% from the peak boom. I mean, Kaylee, did you see hard seltzer as a peak boom in the summer of last year?
When all of a sudden there's like 80 different hard seltzer brands in the cooler at Whole Foods, I think it kind of tells you that, maybe
it's the summer of 2019, Tom. That's when it really exploded in a massive way, and everyone seemed to have a hard seltzer.
They named one after Gary Cooper. There's High Noon or something, which is, you know.
Which you have to buy at the liquor store.
Because it has vodka.
I don't get the rules around where you can buy and can't buy alcohol in this country.
It's clearly Friday.
What is the hard part of the one you can buy at the grocery store? If it's not vodka, what is it?
I think it's a lower alcohol content, Tom.
Yeah, it's like malt or something.
This has helped everybody out, hasn't it? It's a great segment. Cut this out.
The investment of our team in this was stunning.
Put this one out on Twitter. Yeah, sure. Twitter earnings are coming up. Tom's excited for that. Futures are down a tenth of 1%. We recover just a little bit.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
seeing a bit more weakness now, cracks in consumers, in the housing market.
That's the inflation picture in Europe and globally. It just forces central banks to front load.
The natural slope, I think, for the ECB is to really get at least into this neutral range.
It's tricky for Europe because the ECB is potentially raising rates into a period where we're already seeing slowing growth.
It's always a trial and error situation, and I think personally they made the error.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on a Friday, looking into weekend reading, looking into a critical week next week. And John, for Jerome Powell, and certainly for Germany, it's Fragmentation Friday.
I'd go further, Tom. It's on the brink of recession Friday over in Europe, looking at those PMIs. Dreadful. And looking at that move at the front end of the German Bund curve, Tom. Amazing. Down 25 basis points on a 2-year. That's a big move.
The global price comes in. Copper doesn't come in, John. I'm looking at Chicago. Maybe LME copper tells me something different, but oil giving that economic slowdown indicator.
Our next stop, Tom, PMIs out of America, 9:45 Eastern time. And the data over the last 24 hours hasn't been terrific. Look at the move on treasuries now, down 8 basis points on a 10-year, 279 on a 10-year yield.
Well, that's 279 on a 10-year yield. But again, we saw massive curve inversion this morning out to a negative 225 basis points. Priya Misra, I know, I believe, scheduled to be with us on our Fed meeting here coming up on Thursday. But John, to me, the yield dynamics in America seem so separate after what we witnessed yesterday. All of us picking up the debris of what we saw at 8:30 yesterday.
I think we're all confused by that news conference once it wrapped up at 9:45. Tom, just getting some numbers from Twitter. They come in at 1 billion, the adjusted revenue at 1.08 billion, the estimate by 1.23 billion. So that's a downside surprise there. The average monetizable daily average user. Did I do that right?
You nailed it, John.
Jeez, they've got to fix
Have
this.
another hard seltzer.
237.8 million, the estimate 237.5 million. Tom, the stock is down by 3% after the mess of Snapchat yesterday afternoon.
Yeah, you know, and again, it's a revenue. You know, we say trails estimate is the way we estimate this. But again, I think we misunderstand, John, how small these social media efforts are compared to real tech. Is Kaylee mentioned earlier, Facebook.
Sure, Tom, I'd go further, and Kaylee's going to weigh on this in a minute. They've got a massive execution problem this quarter over at Twitter. I know everyone's looking for a macro signal. I'm not saying you won't get it from the social media companies. I'm just saying maybe look to Alphabet and Facebook next week and not to a company like Twitter, who we don't know who's going to run the company in the next several months, and no one at that company knows either.
Right. Kaylee, you helped us with hard seltzer. Help us with Snap and Twitter now. You're more attached to it.
Well, as John said, it's both a macroeconomic outlook and then also just the fact that they are in the middle of a huge legal battle with the richest man in the world. And they speak to that in the statement. They talk about how revenue came in light. They say that reflects advertising industry headwinds associated with the macroeconomic environment, as well as uncertainty related to the pending acquisition of Twitter by an affiliate of Elon Musk. So it's both and. But to John's point, when we get Meta, when we get Alphabet, some of the big tech giants out there next week, are they going to fall victim to the same slowdown in ad spending as companies look around at what the economy is doing and say, yeah, maybe not so much?
It's a mystery. I guess, John, what's the biggest mystery on the screen as you go to the real yield this afternoon?
It's not a mystery for me. It's pretty obvious, but that's what we've got to look at. It's the drop-off in yields, Tom, particularly in Germany this morning, after the ECB made a move to hike interest rates by 50 basis points and seemingly teed up another one in September. The data is speaking loudly, clearly in Europe, that things aren't good.
8% off the equity bottom, John. 32 on the VIX down to 23. It's not the glory of 10 full VIX points, but I'll take 9.
Futures right now down 0.2%, Tom, on the S&P. On the Nasdaq, we're down by about 1/3 I'll wrap things up for you. Crude down by more than 1 full percentage point. Just about hanging on to 95. Euro dollar 101.70. We've talked about that euro weakness. There it is for you. And in the bond market, down by 7 basis points. And just Tom, at 280.50 on a US 10-year.
Very good. With us now, Liz Young, head of investment strategy at SoFi, always with a different and twisted view. And for you, Liz Young, it's the things to watch into August that are different and twisted. Which indicator, which ratio matters to you as a crystal ball for August?
Well, first and foremost, next week matters to me a lot because we're going to get not only economic data, we're going to hear from the Fed again. And right now, the expectation is that this is maybe the last really big hike that we get before they they could slow down at least the size of hikes in September. Also, next week, we're getting more than 30% of S&P components reporting earnings, and that's going to be across sectors. Now, earnings season has been mixed, not terrible so far, but we have heard from a lot of companies that they're thinking the following environment is going to be more challenging. So they're preparing themselves for that challenge. I think next week, when we really hear the rubber hit the road on how this has affected companies in the consumer space, in the materials space, industrials, that's where you feel that squeeze of inflation.
Liz, with that in mind, how much confidence do you have in the bounce that we've seen in the stock market?
I don't have a ton of confidence that it's durable yet. I think it's dangerous to declare victory before we've seen any moderation in inflation. And the other thing I would say about that is I think what the Federal Reserve wants to see is that there's a trend down in inflation. And a trend, as we know, is not just one data point. So even if inflation starts to moderate with the July data, that doesn't mean that it's over. We need to see that happen for, in my opinion, 3 consecutive months before the Fed is going to say, okay, you know what? It's working. We can take our foot off the gas pedal of this tightening.
Okay, Liz, so you say it's dangerous or at least too early to call the bottom in the equity market. Was it too early to call the death of the 60-40 portfolio again, as we've done so many times? Because I'm looking at a pretty healthy bond rally right now.
Yeah, look, I think it was probably okay to start thinking about 60-40 presenting an opportunity again. Now, it wasn't wrong to say that 60-40 didn't work for a long time. That was very much true. And while we had low rates and bond yields were as low as they weren't providing that diversification benefit. But now, to your point, there is more of an opportunity in bonds. But here's where I would be really, really careful. You can't just paint with a broad brush in bonds. You can't say, okay, corporate bonds, there's a huge opportunity too. Because really, if we're worried about a recessionary situation and we're worried about more stress in the equity market, that also means more stress in corporate bonds, both investment grade and high yield. Those spreads have gotten a little bit worse, but they haven't gotten as bad as you would expect them to be in a recessionary environment. So you have to be looking at treasuries and those really high quality bonds.
Well, what would you be looking for on high yield spreads then? We've heard this week 700 plus.
Well, yes, and spreads have doubled since the beginning of the year. But think about where they've gotten to in other recessionary environments. You hear them above 10%, right? They may not get to that level, but they could widen out from here. So I would just be careful in that space, because what you see usually is the equity market is going to correct, right? But then there's this big correlation between equities and high yield bonds. The other thing is you're already hearing from companies that have credit card businesses that they're preparing for loan losses. They're preparing for consumers to not be necessarily spending as much and maybe for that payment cycle to slow down. So you have to think about that as well as a debt market indicator.
Liz, got to squeeze this in. One of the big winners this year, the energy sector in the stock market. It's rolled over a lot since June. Liz, it was the beneficiary of the big inflation trade this year. I just wonder, Liz, how it performs as growth continues to decelerate in the back half of this year. What are you looking for there?
So I think you have to separate what energy is trading at versus what energy stocks might trade at. And if you are an income investor, and you are a cyclical investor and you need to balance your portfolio, energy stocks might offer an okay opportunity, and they are paying a nice dividend. So it's not that you need to get out of energy stocks. But if you take the other side of that and look at the commodity itself, because we're seeing a slowdown in demand, because we're all hoping for a slowdown in inflation, and we have central banks trying to fight that demand story, I don't think that energy as a commodity is going to see a ton more upside. It could stay elevated compared to where it was before, but I don't think that there's a ton more juice that we're going to squeeze out of it as an energy trade commodity-wise.
Liz, awesome to catch up. Looking ahead to next week, Liz Young there of SoFi, with equity futures down by a little more than 1/10% on the S&P. On crude, Tom, we're down by 1.3% to $95 and almost breaking down to 94.
There's a weight, but I really want to say equity's resilient here, and I don't know which way it cuts it. I mean, Snap gets all the headlines, but what I saw yesterday, for example, from the health company Danaher, what you see from American Express today shows me, and Julian Emanuel summarizes, equities are resilient within all the economic gloom.
Twitter resilience, Tom. There's one for you. Put that in a headline. Stock's only down 2%. Katie, off the back of this mess.
Only as they cite the same advertising headwinds that we heard Snap talking about. Snap's punishment far worse. That stock's down the better part of 30% in pre-market trading. Also down in tandem with both of those, Alphabet and Meta. Alphabet right now off about 3%, Meta more than 4%. We get those reports next week, Tom.
John, I'm really focused here on what you and I need to do to finish the month strong.
Here we go.
And
What is
value to Bloomberg surveillance. And I've never seen a friendly. I mean,
okay. What game do you want to go and see?
I would say Tots Roma.
Where's that taking place?
I don't know that. I want you to. I can't figure out if it's.
You're the one who knows this stuff now.
No, I can't. They flip them in Europe, folks. Like, I think it's in Rome because that's the way baseball is here.
Usually the first team is the home team, Tom, but typically in a friendly pre-season, that could be anywhere in the world. I've got no idea. It might not be in North London.
Well, we need to do further research on this, John. I think it does. It's a value add that we can add to Bloomberg.
Someone's going to message me immediately to tell me where that is, Tom. So when I find out, I'll let everyone know. It's a friendly.
Are friendlies like friendly?
They can be, Tom. People are usually less aggressive.
Do the stars play? Does Harry play?
Some of them do, and you try and get the rest of the squad on too, so they get fit for the season that starts in early August.
That's what you and I do.
This is us right now, getting fit for the Federal Reserve meeting next week. What are you on this morning? Honestly,
seriously, folks, they
are killing me this morning.
John's entourage just sent me the lineup for July 27. John, we have the greatest set of bookers on the planet. Extra tang this Friday.
Please
Spiked
don't.
Tang,
Please
clearly.
don't. Hard tank. Hard tank. Futures down at 10.
I'm talking to them right now.
Dear me. This is Bloomberg.
Keeping you up to date with news from around the world with the best word, I'm Ritika Gupta. Commerce Secretary Gina Raimondo warns that the U.S. can't keep relying on Taiwan for semiconductors. In a virtual speech to the annual Aspen Security Forum, Raimondo said Congress needs to pass legislation to support the domestic production of high-end computer chips. She called the $50 billion package, quote, a Sputnik moment for America. Progressive groups want Senate Majority Leader Chuck Schumer to recuse himself from legislation targeting big tech. They say he has a conflict of interest because of his daughter's work at Amazon and Meta platforms. 16 groups have been advocating for antitrust measures cracking down on tech giants. No comment yet from Schumer. And there is another sign that a recession may be on the horizon in the euro area. Private sector activity in the region unexpectedly shrank this month for the first time since the pandemic lockdowns of early 2021. A survey of purchasing managers by S&P Global dropped to a 17-month low. Manufacturing output fell and service sector growth almost stalled. In the UK, a new poll shows Foreign Secretary Liz Truss extending her lead over former Chancellor Rishi Sunak in the race to be the next Prime Minister. According to a YouGov survey of Conservative Party members, 62% said they would vote for Truss and 38% went for Sunak. An earlier poll this week had Truss leading by 19 points. And American Express posted second quarter revenue that soared 31% to a record that led the company to raise its forecast for full year revenue. Amex customers kept spending on travel despite those mass cancellations and long waits at the airport. Meanwhile, the company's expenses rose a more than expected 32%. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
fears about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The research team at Bank of America has the year-end recession, which they made a call on a few weeks ago, but it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out, but it's more the impact of the Fed raising rates and slowing economies.
Brian Moynihan there, the chairman and CEO at Bank of America, catching up with David Weston. Always good to hear those two in conversation. Futures down 0.1% on the S&P, on the Nasdaq 100 down 30 points with negative 0.2%. Yields much lower this morning, down 6 basis points on a 10-year to 281, even lower over in Germany. We've got to talk about that data out of Europe. Just terrible. Sub 50 on the PMIs, in contraction, yields lower in Germany, Tom, on a 2-year by 22 basis points.
John, I've been remiss on this. Javier Blas comes to the rescue. You had the French bailout last week of energy, and this morning you have Germany's Uniper, UNIPER, which I guess is basically a modern utility, if you can call it that, John. And I calculate off Blas's work that the bailout is 1.33 million per employee, just as one metric of 11,000 employees as well. But again, it's government to the rescue.
The $9.1 billion. My understanding, Tom, based on our reporting, is that they take a stake of 30%. That holding gives them a big enough holding to have veto rights on what we call important strategic decisions.
I don't know.
And later this year, there's going to be some big decisions to make, Tom.
It's a new capitalism and speaks to the crisis at hand in continental Europe. Right now, he's been very hard to get through to because he has extra vacation days at Bloomberg. Damien Sassower joins us right now, our chief emerging markets credit strategist. Damien, I'm watching Malaysia unwind. Philippine pesos, maybe the bank's got a level at 56, and on and on and on. What is the great unwind of EM as we go into this weekend?
Well, Tom, one of the places that's been a relative safe haven has been Asia. I mean, Asian FX, if you notice today, amidst all that you're seeing in bond markets, Asian FX is the only market that's up here on the day, right? So, I mean, you talk about the rupee, you talk about the Malaysian rupee, you talk about the Philippine peso. They have been a relative safe haven amidst the morass of emerging market currencies. And let's be very clear, emerging markets, there is no good news. I mean, as you rightly pointed out last week, an 18% year-to-date decline in the EM credit has wiped away over 5.5 years of profits. If you look at EM local debt, 7.5 years of profits have been effectively wiped out by this year's performance.
How big of a crisis is this to the Western world and specifically to the International Monetary Fund?
Well, I mean, it's been relatively ignored by the developed market central banks. I mean, we know that the big four central banks, the Fed, the BOJ, the ECB, and the PBOC are now scaling back their balance sheet. I mean, on a year-over-year basis, the combined balance sheet of the big four central banks is now down 4.7% year over year. Tom, the last time that happened was the end of 2018, and stock markets reacted really rather poorly off the back of it, down 20%. So, look, we expect some weakness ahead for sure. We expect some gaps in the plumbing system for sure.
As we're talking about weakness, let's talk about China, because we've had a lot of conversation about just COVID-0 and the impact that has had on the Chinese economy. The property sector, Damien, it seems like every morning I come in, I read in on what happened in Asia, and it's that things have devolved even further, that things are getting even worse in a huge chunk of China's economy. Have we fully come to understand the risk of that?
Kaylee, that is a great question. And it's not helping that China's actually censoring information around the mortgage crisis, which is going on there. But from my perspective, the whole pyramid is collapsing now, Kaylee. I mean, the fact that you've got mortgage boycotts, I think, over 100,000, homeowners are not paying their mortgages because they never got a home off the back of it. They pre-sale. So now it's expanding to the banking market. You hear ICBC, Agricultural Bank of China is feeling some pain off the back of it. Remember, the housing market in China, Kaylee, it's 40% of middle-class household wealth. It's 35% of the funding for local governments domestically. I mean, it's a big part of the economy, 25% of GDP.
So then what's the policy response, Damien? I mean, how much do you have to ease and support to get that bleeding to stop?
They need to incent local governments to come in and help finish some of these undeveloped projects. That's what needs to happen right now, so that the projects are finished, so that people have their homes and they continue to pay their mortgages, or they begin paying again. But right now, I mean, it's a far cry from seeing that, and banks just don't want to lend in China. So that's really where the rubber meets the road. We need to get the banking community involved, and right now there doesn't seem to be an incentive or a willingness on their part to do so.
Damien, smells like a balance sheet recession coming up, doesn't it?
It does indeed. Look at you. I mean, look, for me, look, I mean, you guys call me, it's a Friday summer morning, the Yanks just got swept by the Astros. Look, I'm wiping off the cobwebs here, but if you want to talk balance sheets, I mean, again, you look at the big four central bank balance sheets, and the fact that they're getting smaller is never a good thing for money supply globally. It's never a good thing for emerging markets writ large.
You always want to talk about sport. French Grand Prix this weekend. Damien, what you're looking for? I know you're into F1 now. This is a change.
I've been watching Drive to Survive. I love Max Verstappen. I love Red Bull. I love Christian. I mean, look, Scuderia. I mean, Carlos Sainz is my favorite racer, but Max Verstappen. He's going to be hard to beat. I love it.
I'd like to get Horner on the program and introduce Tom to Formula One properly. We got him into football eventually, Damien. We can do that on Formula One, I'm sure. Damien Sassa with the latest. Thank you, sir. TK, what do you think? Bit of F1 in your life?
I don't get
make
it.
that work.
The late, great, wonderful Ken Pruitt, who taught me so much, tried to teach me F1.
He couldn't convert you, Tom.
And Ken went down in flames.
Tom, I got a ton of messages about Tottenham, Roma. It's in Israel.
I know. I just priced it out. I mean,
You priced out the ticket.
It's on the road trip now.
Well, no,
the flight, or the actual ticket to get into the game.
Mary, genius of all, priced it out for me. I went to her, and I think, you and I need to do some research on the Levant, and it's for the two of us, John Business. We don't have to sit next to each other. $10,796.
Return.
Round trip.
Business class.
Business.
And then you've got the hotel, the price of the ticket. Seems like a lot of money just to go for a friendly, Tom.
It's a friendly.
We should be there for the start of the season in North London. That's what we should do.
We should.
Just go and watch Tottenham's first game.
Where's is Haifa near Tel Aviv? I don't even know.
I'm not sure, Tom. I'm sure you can work that out. I can't believe you bothered the travel team all morning with trips we're never going to take.
Mary and I we're best buds.
Yeah, I'm sure Mary thinks the world of you. I'm sure she does. Tom, the market is okay on the equity side of things. It's a friendly equity market over the last couple of days. We're down a 1/10 of 1% on the S&P.
Look at the VIX. Come, John,
Tom,
the VIX, 22.95. Sure. Everyone out there into the weekend says the world's coming to an end in equities. Michael Hartnett, read it. He's right. Dan Ives agrees.
Hey, Michael Hartnett's great. What do you make of the bond market move?
I don't have much on U.S. bonds. Frankly, I'm looking at Germany. I mean,
so am I.
Yeah, but you started looking at 5 a.m. I started looking at 8:15.
Well, I'm pleased you're catching up, Tom. The data just wasn't great at all, and I think what we're looking for now is to see what happens with the US PMIs at 9:45, and we hope they stay in positive territory in the 50s and expansion.
How many PMIs are there?
Which ones, Tom? You mean
you've got
the S&P Global PMI, then you've got the ISM survey as well. There's some different ones, Tom, in different places.
Okay.
Is that helpful?
It's helpful. Kaylee, help me here.
I have no idea what you want me to say, Tom. I'm just
told
listening
that
to you two.
Haifa is in northern Israel,
Yeah,
on
it's
the
in northern
Mediterranean.
Israel. Yes.
Well, if you knew that, why did you ask? You wanted me out this morning. I've got 30 seconds to myself. Just let me be. Futures are down by 0.06% on the S&P. On the Nasdaq 100, we're down 26. We're down 0.2%. Off the back of the data in Europe, which was dreadful, sub 50 on the composite PMI. Your euro's weaker. I said, let me be. Just let me have my moment.
John, here's what it's about.
Can't you
Your
just let me
base.
speak?
John, your base.
You just let me speak.
Your base.
You get so excited to talk all the time. It's like anchoring with a child. Just wants to speak.
Your base.
Euro dollar, Tom. Take this out. 101.88. Where's the Dow?
Where's the Dow?
Where's the Dow?
Dow futures up 74.
There we go. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
from New York City this morning. Good morning. A lot of people writing in asking when's Bramo back to babysit you and I, Tom. Monday,
I
I'm
clearly
told.
am not doing an adequate
Monday, I'm
job.
told. Well, you're just leaving us unleashed.
Have another hard seltzer, Kaylee.
Futures down a tenth on the S&P. We're down a third of 1% on the Nasdaq 100. Yields come in by 7 or 8 basis points. A break of 280 this morning, 279.96. The big break lower in Germany. Bunds just rallying hard. We're down 22 basis points on a 2-year in Germany, on a 10-year down 17. And I've said it how many times this morning, Tom? The data in Europe, just dreadful this morning.
We're making jokes about it, but it's not funny, and it's certainly not funny for the people of the continent of Europe. And frankly, John, I bring it right over to the United Kingdom. I think it rounds on there. And what I'll be watching, John, is currency markets, is the litmus paper there. And I'm sorry, they haven't broken down yet, but you got to watch Eurodollar into the weekend.
Euro can't get a bid even with a 50 basis point high, Tom, because I don't understand the reaction function of the ECB. I certainly don't understand what TPI is, and I've got no idea what happens with gas supply later this year. You put it all together, it's why people like Kit Dukes of SocGen think that euro is still unbuyable.
Yeah, absolutely. We begin right now our coverage into a July 27th Federal Reserve meeting, which in sequence with the last one and maybe in sequence with the next one, is truly historic. A student of this, of the history of the nation's economics and the action of it, is the former Richmond Federal Reserve President, Jeffrey Lacker, and we're thrilled that Professor Lacker could join us this morning. Jeff Lacker, I want to go back to one of my heroes, a gentleman from Washington University at St. Louis, the laureate Douglas North, who codified the word ambiguity and also did a careful study of the dynamics, the movable parts of our economy. All of our listeners, all of our viewers are drowning now in the dynamics of our economic world. How do we get control of it?
Fed has to do its job, get inflation down. It's the institution with unique control over monetary conditions in the United States. Together with the fiscal authorities, they drive inflation. And the Fed's got to do its job now and do what it takes to get inflation down. I think Chairman Powell has been right in recent months, since March, to emphasize that maximum employment is going to be out of reach until we get inflation down. And we need to put concerns about the labor market and what it's doing a little bit to the side and focus on getting inflation down. That's going to take reducing spending growth, reducing nominal spend, and the labor market will play out as it will.
Your shop codified economic history with Thomas Humphreys, one of my heroes. I've read every single page he's ever written. Right now, Thomas Humphreys would be writing about comparing Volcker to Powell, Powell to Volcker. He's not Paul Volcker, right?
So Paul Volcker was a great central banker in an age of monetary mystique, an age in which central banks deliberately cultivated some obscurity and a distance from the public. They didn't want to be in the headlines unless, they wanted to choose when they'd be in the headlines. We're in a different day and age. Getting inflation down revealed to central bankers around the world the value of managing expectations and the value to that of being transparent and communicating about, what they're trying to do. Jay Powell strikes me as better suited for the age of central bank transparency than Paul Volcker in terms of personal demeanor. The one big thing that Paul Volcker had was the backing of the political establishment in Washington and New York to get inflation down. They were fed up with it and they were willing to take the pain, and he cultivated an appreciation of the pain that was needed to withstand in order to get inflation down. And I think Jay Powell seems to have abundant political connections and abundant skill in managing the Fed's political connections. And so he seems pretty well suited on that grounds too.
Jeffrey, this is a delicate subject, but you've touched on it. So let's go there. How political is this Fed right now?
So I think they understand that there's nothing that could damage their credibility more than sustained inflation. They can take all the hits they want on employment and the labor force and climate change and what have you, but job number one is inflation. If they don't get that down, I think they realize they're political toast in some sense. So I think that's true of any Fed, no matter what people say about independence. I think it's true of every Fed.
Are you convinced they're willing to tolerate a recession to get inflation down?
Yes, I do. And they should.
Jeff, what kind of recession? Because the consensus right now is short and shallow. Do you share that, let's say, more constructive view of things?
I'm tempted, given today's news, yesterday's news, to say a Mario Draghi recession, whatever it takes. Because the alternative, to let your foot up off the brake before inflation has come down, let it settle at 4 and 5%, that's just a recipe for another recession down the road. That's a recession for prolonged pain, making the agony longer and longer, stretching out over years. That's not good for the American public. I think they realize that. So they're going to have to, what they ought to do is stick with it until they get inflation down to under 3%, say, within spitting distance of 2%.
Okay.
And go from there.
Okay, so whatever it takes, what is it going to take? What rate on Fed funds? What rate on unemployment?
Good question. So I think the historical record is clear that they need to get the real federal funds rate at or above 0. So that begs the question, all right, so the real rate is the actual Fed funds rate minus expected near-term inflation. Best reads of that are about 6%. You've got the Michigan survey at 5.2, the New York Fed consumer survey, which is great, very good methodology, at 6.8, split the difference at 6%. If near-term expectations of inflation stay at 6%, they're going to have to get there. If those near-term expectations start falling, then what we have in store is a rendezvous between the Fed funds rate and expected inflation. But I doubt that expectations are going to fall to 3.5 or 4 by year end. So I suspect they're going to have to go higher than that.
And how quickly would they need to get there? I mean, 6% is still a long way away, even with the supersized hikes we've already seen.
I don't think slowing down the process does them a lot of good. No matter what, whether they go 50s or 75s, they're still going to be in a situation where the effect on inflation is out into next year. You're going to have to make a judgment about when to stop without knowing whether they've done enough or not, based on other indications and other calculations, like the one I cited. So they might as well get it done. They might as well get there fast.
Jeff, do you look at the path back from this inflation to whatever's normal, 2-3%, let's not get into that now, is having a smoothness, a glide path, as Peter Orszag would call it, or is it kinked where we get to a point, we stop, we try to figure out how to lower inflation next, et cetera?
If the Fed tightens enough, I think we'll just see a gradual decline down. I think it'll sag over a couple of years. Mm-hmm. I expect it to be relatively smooth. I don't have any reason to expect any jolts, absent other shocks like more oil price problems and the like.
Jeff, how would they respond, do you think, to that negative supply shock on the energy side? I'm interested in that, not just for the Federal Reserve, but maybe more so for the ECB on the gas side of things. I don't know if you followed that news conference yesterday with Lagarde, but I think we all failed to establish what their reaction function actually is and how they'd respond to a negative supply shock that pushed gas prices higher and potentially growth lower.
This is a murky area because oil price shocks tend to cause unemployment. People think, well, you need to ease, that's a reason to ease policy. But if you think about it more broadly, the central bank's controlling the real interest rate, which is the incentive to save and delay consumption, delay spending to later. And if you get a supply shock, you want people to wait and consume later. So what you want to do is raise rates, at least one argument goes. So there's a case that it doesn't mean not staying the course on inflation.
Interesting. Jeffrey, great to catch up. Jeff Lacker there, the former Richmond Fed president. Thank you, Tom. Looking ahead to the Fed, that this Fed might have to tolerate what he called a Draghi recession, or whatever it takes recession, to get inflation down. There's a call.
They're doing it into 22, and particularly, John, they're doing it into the campaign of November 24. And unlike the sanity of the United Kingdom, I would suggest, John, that campaign starts the first Wednesday of November this year.
Oh, Tom, you've raised an interesting one. You think this Fed will be deterred from hiking because of the midterms?
I think this Fed will be a political Fed, as it always is, as they tell us they're not.
Interesting, even with inflation
Always.
printing where it is. Tom, do you want to join me on the 9? I've got Matt Hornback and Morgan Stanley, PIMCO's Jerome Schneider, Kate Moore of BlackRock.
I got the CEO of Boston Beer on
You want
our
to join me for that? Have you actually got the Boston Beer CEO on radio? I think I'd tune in for that.
Last time he showed up with us a case of Sam Adams. It was good.
And some hard seltzer, which
I've never had one.
You haven't, Tom?
No, it just, I look at it and go, I don't. It's
I
like,
bought some of
it's
that
like
White Claw, put it in the
Bitcoin,
fridge,
I'm
and it
like,
just
no.
it stayed there.
I'll take
Kaylee?
it from you. I'll get it off your hands.
What's your favorite hard seltzer?
White Claw, specifically
It's
black
still-
cherry flavor.
Oh, there we
White
go.
Claw Black Cherry. Okay. And it just tastes like fizzy water with
Thank
a
you,
hint of
John.
black cherry.
There's a little fun in it, you know?
Okay. Fun on the weekend in Brooklyn, Tom, if you're interested.
On my
White Claw,
patio,
Black
my
Cherry,
discount
nice.
Target
with your
patio
Target
furniture.
patio furniture.
Yeah.
There's a lot of economics going into this.
We're deep into research this
Saving a
weekend,
segment.
John, on hard tang.
Is that right, Tom? I think I'm convinced you already have hard tank in the morning.
Well, yeah, that's besides the point, but it's homemade.
Is it? Futures are down by 1/10% on the S&P. On the Nasdaq, we're down
I don't
by
like the mango
a third
either.
of 1%.
Tell Anne Marie I don't like the mango.
You have a choice now. You can
She
stick with
brought me back
Bloomberg Radio
from,
at 9
she
o'clock
brought back
to
Jeddah, Saudi Arabia. She
listen
brought
to
back
Tom's
some mango
stories
tang and,
about hard tang, or you can tune in for some market coverage on Bloomberg TV at 9 Eastern.
We're getting competitive, aren't we?
Or you can tune in for Real Yield later. Tom's anchoring a special summer edition of Bloomberg Real Yield with Tom King coming up at 1 p.m. Eastern Time. Thought you'd be excited for that, Tom.
Looking forward. Just
Good,
can't
good,
get-
good.
I'm at a loss for words.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fed Chair Jerome Powell probably will slow the pace of interest rate hikes after a second straight 75 basis point increase next week. That's according to economists surveyed by Bloomberg. They expect policymakers to raise rates a half point in September and then shift to quarter point hikes at the last 2 meetings of the year. Trump insiders told the January 6th committee the former president ignored pleas to call off the mob storming the U.S. Capitol. The panel held a televised primetime hearing Thursday night. Members cast the former president's inaction as a desperate final ploy in his struggle to hold on to the presidency. And the White House is confident that President Biden will avoid the worst of the coronavirus thanks to vaccines and a therapeutic drug. The president is experiencing mild symptoms and has begun taking Pfizer's Paxlovid. He will isolate at the White House whilst continuing his duties. In New York State, the Republican candidate for the governor was attacked at a campaign event. Officials say a man with a pointed weapon tried to drag Congressman Lee Zeldin to the ground before being subdued. No one was hurt. The attack took place outside the city of Rochester. And Verizon has cut its full-year profit and revenue forecast. The largest U.S. wireless carrier is trying to keep up with rivals who have made gains through heavy phone discounts. On Thursday, AT&T alarmed industry watchers with a warning that some customers are starting to delay paying their phone bills. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People are starting to buy less goods, but they're paying more money. This is going to start to weigh on inventory adjustments, which is going to weigh on GDP. This is not good for profit margins. This is not good for earnings. Things are starting to slow down more materially than maybe what many in the markets are thinking.
Your first fixed income brief of the weekend. James Karen over at Morgan Stanley. I urge you to see that in its entirety on Bloomberg Digital as we all reframe into a Fed meeting on July 27th. Kaylee Lyons with me in for Abramovitz. I'm told I had a lot of emails. She's had a wonderful time and is like halfway back from Kathmandu. I don't even, I'll be honest, I don't even know what the path is, whether it's through Qatar or whatever, Kaylee. Right now, and this is really important, I line up Kenneth Rogoff with his book, The Curse of Cash. Is one of the most courageous books written in the last number of years. There's our Steve Engel out of Hong Kong and the courage he has done in reporting some of the challenges of the Pacific Rim. And in securities analysis, there is Richard Greenfield, who was tarred in feathers years ago with a small upstart called Vonage. It wasn't funny at the time. Now we can look back with joy, and we're thrilled that one of the leaders on media, Rich Greenfield, joins us today with Lightshed Partners on the challenges of Mr. Musk and Chancery Court. Rich, just as a beginning point, do the earnings today matter?
I mean, they matter from the standpoint of it's yet another signal that the online ad market is slowing. You saw it from Snapchat last night. You've seen it from Twitter. There are now just a building series of signs that the economy is slowing and advertising is slowing, whether that's inflation driven or just overall broader economic weakness. It definitely, look, there's very specific Twitter challenges with Musk, but the overall macro environment is clearly weighing. We'll see the big bellwethers in Google and Facebook next week, but this is certainly not these are negative data points, both of them for investors right now.
Well,
in this
Rich, I got to rip up the script here. Let's jump over to next week. Are we going to see the big boys, and frankly, including the Amazon advertising model, are they going to be diminished as well?
I mean, look, Google has been talking about YouTube bearing some pressure. I think there's no doubt the connected TV ad market is certainly slowing. I think you're going to hear that, whether it's from Fox or Paramount. Like, I think everywhere you look, connected TV is slowing. The TV market, especially local TV, is starting to slow. The economy is weakening from the standpoint of advertising. Companies are seeing top line growth slow. What do? They cut back on marketing spend. This is not new. I mean, you and I, Tom, have lived through multiple cycles over decades. Like, this is what companies do. When things start to slow, they cut their marketing spend. There's nothing shocking about it. The question is only how long will it last and how bad will it be? Is this a deep, dark recession through 23 where ad spend gets crushed? Or is this more of a shorter term phenomenon and we bounce back in 23? And I think that's the big question we don't know right now, but I definitely think you'll see Meta, I keep saying Facebook. We will see Meta certainly talk about a slowdown, in a continued slowdown in ad revenue, and probably give relatively underwhelming Q3 guidance. I don't think as bad as Snapchat, but I don't think it's going to be a great, great outlook for them.
Well, for Rich, to bring it back to Twitter, they did talk in the statement about those advertising headwinds, but they also said part of it's reflective of uncertainty related to the acquisition of Elon Musk. What is your base case about what the verdict will be in that Delaware court in October? Is he going to be forced to buy this company for $54.20 a share?
We really do believe he's going to be forced to buy this company for $54.20, Kaylee. He signed this agreement when the case in Delaware, which is going to be litigated on an expedited basis. He already lost the push to push this out. I think my guess is the judge is going to look at this and go, the entire Elon Musk case essentially rests on this question of bots. And did Twitter disclose the proper amount of bots? The problem with that, Kaylee, is when you read the merger agreement, it never talks about bots. There's no discussion of bots. It just relies on Twitter's public filings. And if you read Twitter's public filings, it says, this is how we count bots, or this is how we count real users, but we could be wrong. So I think when you actually read the documents, it's very hard to see how Elon, feels like he's got buyer's remorse. He just doesn't want to buy it anymore, whether it's the market, the environment, I have no idea.
Well, to that point, Rich, what happens to a company if someone is forced to buy it who doesn't want it?
Well, first of all, it's happened before. The specific performance, which is being forced to close a transaction that you signed back in the financial crisis, there is precedent for being forced to buy a company. That's his problem, not Twitter's.
Rich Greenfield, very quickly here, and I want you to take a broader Walter Piecyk, Rich Greenfield view. Is there profit in streaming? Is it a durable business, or do they compete it all away, spending $200 million on the gray man?
Tom, it's an excellent question. I think the way to answer it is, right now, you are seeing one company make a lot of money, which is Netflix. Netflix is generating $6-7 billion of EBITDA, is generating dramatically more free cash flow next year. Everybody else, whether we're talking about Disney or, Peacock is losing $2.5 billion a year. Paramount Plus lost $1 billion in the last 2 quarters. Everyone is just drowning in red tape right now. This is like a black hole of streaming because there's too many companies competing and they don't generate a significant amount of time spent in streaming. Netflix is 30% of all time spent streaming on a connected TV. YouTube is 20%. Everybody else is tiny. And that's the problem, is they're all spending billions upon billions of dollars and they're not getting substantial viewership. That's the problem.
I got 10 more questions in no time. Rich Greenfield, thank you so much for joining us with Walter Piecyk at Lightshed Partners doing work. Again, we protect the copyright of our analysts and our guests. Get it from Lightshed Partners there as well. Kaylee, seriously, I want to look at crypto out to next Tuesday as well. There's a back and forth right now. Who has the upper hand? Crypto developing as a business, or people really pushing against it?
Right now, it seems that a lot of that leverage has gotten washed out, and we've actually seen a breaking out of the trading range it has been in really for the past month. We are now comfortably above $23,000, so that's, of course, something we'll continue to dig into. And I know this is probably not what you're expecting from me, Tom, because you know I always push crypto, but this bond market is what has my attention this morning. We're down 23 basis points on the 2-year German bund yield, 20 basis points on the 10-year BTP, and it is a weaker euro, even though we got a 50 basis point hike from the ECB yesterday.
And 2.81% in the U.S. 10-year, showing those concerns about economics. And I believe John Farrow, let me get it up here, Kaylee, because of course I haven't looked, where Farrow's all over it. 9:45 a.m., we will get the S&P global PMI numbers, which will make a lot of sense. I think, Kaylee, another thing we have to look at, excuse me, is West Texas Intermediate coming right up and then right back down. $95 a barrel is not 120, is it?
It is far from it. You're seeing a cooling in oil. We're also seeing a cooling in wheat and corn because we're looking at potentially a grain agreement being signed in Istanbul later today. The energy price pressures, the food price pressures that people have been feeling, there are signs that that's going to come down. And I wonder what that makes for central banks like the Fed responding to headline inflation. Thank you, Tom. I've spent a week with you. You know, I learned something.
Well, please, Farm Girl from Fargo would have nailed that. You know, days ago, corn, seriously. One of the stories this week, plunging. Next week, a rumored return of Lisa Abramowitz, where she will co-host Farm Journal. Stay with us on radio and television. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Looking to wrap up a decent week of gains. Live from New York City this morning. Good morning, good morning. Directly market just a little bit softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue. It's the end of forward guidance.
Forward guidance is dead. It looks like there's just no visibility whatsoever.
Earnings and news out there.
Snaps, results.
The European Central Bank. I have no idea what's going on.
Forward guidance seems to be a thing of yesterday.
The ECB raising rates more than expected. Suddenly we have these leaks and 50 basis points. The ECB clearly wants to live in the moment and govern that way.
Other central banks have done it.
Forward guidance has become a little bit more unpredictable.
And certainly we saw that with Snap after the close.
Outlook quite negative.
Definitely a bad precursor. Forward guidance now is moving to its next chapter.
The end of forward guidance
is a good thing. Joining us now is PIMCO's Jerome Schneider, Morgan Stanley's Matt Hornback. Matt, let's start there. The central banks can't forecast. The companies are struggling to guide. Where does that leave us?
Well, John, it leaves us looking at the economic data just like central bankers are, and that's what they're using to judge the appropriate stance of monetary policy. And your last segment there was just on forward guidance. I mean, the central bankers are looking at exactly what we're looking at. We should be interpreting the data as we think they will interpret the data and make those decisions meeting by meeting.
Matt, that's easy if they do a decent job of establishing their reaction function. Do you think both the Fed and the ECB, for that matter, have done that?
John, I think they have. They've been very clear that their number one focus is inflation. I mean, it is the only mandate of the European Central Bank. The Fed has a dual mandate, but it has been very clear, John, that its main focus right now is inflation. So looking at the CPI report from last week should tell investors quite a lot about what to expect next week.
So Jerome, with that in mind, is an easing of financial conditions over the last couple of weeks, should we consider that an unwarranted one?
Well, obviously the financial conditions are taking a backseat right now to, again, that inflation discussion. And quite honestly, investors should really be not paying attention to too much other than the continued dialogue and, more importantly, the road to the turn of inflation that is likely to come. Quite honestly, I think what we're really faced with is a lack of consensus in the consensus view, meaning the consensus views that we see in inflation, with growth, with even monetary policy and what the terminal rates are suffering from really a shorter half-life every time we have these discussions. And so while the Fed and perhaps the ECB has actually made a concrete goal of fighting inflation, and we need to keep our eye on that, those consensus views are incredibly creating volatility in the market in that short term. And so the data dependency of the central banks, the consensus views of the market, which quickly become non-consensus, those shorter half-lives are really creating vast changes in risk appetite. And we've seen that clearly over the past 24 hours.
Jerome, directionally, though, when the consensus view has been wrong, the correction has been in the same direction each time. It started out with fewer Fed hikes, then it started out with more, then the consensus shifted to 25 basis points every single meeting, then it was 50, then it was 75. Is there something to learn from that? Ultimately, Jerome, that directionally the consensus has been wrong, and when it shifts, it's to a more hawkish stance, a worse economic outcome.
Well, everybody wants to think about the worst case outcomes when they're wrong, clearly. So expect the unexpected. And quite honestly, that's what the Federal Reserve and other central banks are trying to do, is trying to remove that certainty from the equation so they're not held to any one paradigm or road to the calculation. Quite honestly, when you look at the road to inflation, clearly some people think that core inflation has turned. Perhaps, energy prices have taken a turn, but perhaps not. And so really for investors, what we want to be focusing on is the macroeconomics, understand the macro variables in play, but understand within that broader economy segment, while there are questions with regard to the potential for recessions over the next 12 months or so, at the same time, the destination of where we are getting is actually less important today in the higher rate regime of 3 to 4% interest rates. And so for for investors, they should just simply take a step back, evaluate where we've come from, and really rationalize the policy measures in the microcosm of what they are, is that the Fed's going to do its job fighting inflation. Jerome Powell has made that very clear. And ultimately, when they find success, it might be at another 25 or 50 basis points higher or lower than the market currently expects. But the bigger picture is actually somewhat of a comforting one for investors, especially where yields are today.
Jerome, people don't feel comfortable. Maybe the clue's in the name. You're the head of short-term portfolio management, so help me understand what I should do right now, Jerome.
Yeah, quite honestly, it's all about understanding volatility, understanding liquidity management, being a little more defensive. You know, while we had, financial conditions easing, as you mentioned a few moments ago, the reality is that there is a lot of potential negatives for headlines. The balanced view is one where we take a little bit further view out, understand that we are in a stall speed for the economy, nearly a stall speed. The probability of a recession is somewhat higher over the next 12 to 18 months. But at the outset, we need to find ways to reduce risk, to understand that there's ways to manage around this. And it's really by simply taking smaller bites in terms of risk appetite, raising cash levels, looking to manage liquidity in a more proactive way. And what it really does, quite honestly, Jonathan, is helps reduce the inter-day and really inter-week volatility that you see from the reverberations of these changes in sentiment, of these changes in consensus. And so the right thing to do at this point in time is actually position yourself for a little bit of patience in your portfolios and have those higher cash levels and perhaps take advantage of the higher relative rates that we're seeing in the front end of global interest rates curves.
Matt, does that more defensive, more patient stance at the moment resonate with you?
Well, John, I think you have to learn to expect the unexpected in these markets. I just returned from a 9-day trip river rafting down the Colorado River, led by a man by the name of Ben Whitaker. And this man, river rafting guide, was always trying to expect the unexpected. We got hit with a sandstorm at 10 p.m. at night that lasted for 2 hours. I mean, John, the markets look very much like this to me at this point. We should learn to expect these sandstorms to come out of nowhere, and we need to be prepared for that as strategists and investors around the world. So how do we do that, John? First of all, we have to bet with where we have conviction. Where do we have conviction? Central banks are going to raise interest rates until inflation starts to come down. And John, quite frankly, we don't have great evidence of that happening in too many parts of the world. Look at the CPI report in the United States from last week.
Yeah.
The trimmed means made a new high for the cycle, John. That's dramatic.
I have to say, Matt, that's not my idea of a vacation, but thank you for sharing that story with us. Futures right now, negative 0.1% on the S&P 500. Snap earnings got a ton of attention after the close yesterday, deciding to withhold forward guidance due to mounting economic uncertainty. They're not alone. They join a growing list of companies paring back future hiring. I want to get to the West Coast and catch up with our good friend Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Long time no see. It's interesting because Snap missed on the top line and they talked about a, quote, pretty good deceleration in the ad market over the last 90 days. But the most recent headwind is the inflation headwind. And we are starting to see inflation cracks already in this early part of the earnings season. I think what's so interesting to me is the buoyancy that we've seen in the NASDAQ 100 over the last 3 days, right? Despite that kind of broad reporting on the pullback in hiring, which Snap says it will also do, a lot of that reporting by Bloomberg. And yet, now the market is turning on a dime. We go into a really crucial earnings week where we're looking for signs that there are inflation cracks and that things will change. Twitter, by the way, also had earnings pre-market this morning, missed on the top line, and of course did not give guidance. But remember that guidance was taken off the table the moment that Elon Musk put his bid in to buy the company, which we're still waiting on. But all eyes on next week when the calendar becomes, frankly, dramatic in the mega cap tech stocks that are due to report earnings, many of which, the likes of Apple, Microsoft, Bloomberg has reported, according to sources, will freeze or pull back on hiring, and you wonder what the biggest challenge is for them. I would make a wager, John, that it probably is inflation.
You've got a big week coming up next week, Ed. Looking forward to your coverage on that. A lot of people complaining, I sensed overnight into this morning, about using Snapchat as a macro signal. And Ed, thank you. They've got to let you go. I'm not sure why they're not. Thank you very much, Ed. Looking ahead to next week, we get the big players, the likes of Alphabet, the likes of Facebook as well. That's where you're going to get a macro signal from, not a company like Snapchat with execution problems, a company like Twitter. Look for those big names. I think it was Dan Ives of Wedbush this morning that called it a paper plane in a windstorm, as he referred to Snapchat. Look at what's happening with Microsoft. They said this week they're eliminating job openings. With D.R. Horton, they tempered expectations for home sales. Matt, when you look at earnings, you can get any company to tell you whatever you want to hear. Just select the right company and it'll back up your argument. But when I see companies like Microsoft get rid of job openings and companies in the business of selling homes temper expectations for home sales, isn't that exactly what this Fed is trying to achieve? Just take a bit of demand out of the situation. Just take a little bit of heat out of this economy. Aren't those positive developments?
John, you're spot on. This is, I think, exactly what the Fed and other central banks are trying to engineer, is a slowdown in demand, not one that is so dramatic as to lead to a recession and the unemployment rate inflecting a lot higher. But John, this is where it becomes difficult for central banks. They have a tough time controlling the economy in the best of times. And here we are going into a very uncertain period of time. We're starting to see indications in measures of confidence among CEOs. I think that's a very important metric to keep an eye on. CEOs and the boards are ultimately making these decisions about hiring and firing. So we have to keep a close eye on CEO confidence, and that's been coming down quite a bit, John, over the recent quarter.
Of course, what we don't want to see is a cut in job openings and hiring intentions develop into a wholesale cut of the workforce and unemployment run away and the downturn, the economic downturn that many people fear. Matt Hornbach and Jerome Snyder are going to stick with us because we need to talk about this ECB. Before we get there, we need to talk about this market. It's turning around, going into the opening bell, taking a look at some single names. Here's Kelly Lyons.
Well, it is absolutely brutal for Snap this morning. Ed just running us through the results, but we are talking about a stock down 32% in pre-market trading this morning after already being down 65% year to date through yesterday's close. That sucks. That just is really, really rough. And of course, this would be the fourth move of 20% plus in the last 5 quarters. Also down hard, Seagate, it's a maker of computer hardware. It missed on the guidance, citing the macroeconomic outlook. It's down about 10%. Boston Beer is down about 8%. You, Tom, and I have spent way too much time talking about hard seltzer this morning. So all I'll say is Truly's not doing great, and they're blaming that in part for their guidance cut. And we also saw a guidance cut over at Verizon, a big miss on wireless. The conference call is ongoing right now, John. Executives talking about inflation affecting consumers and that higher costs will affect profit in the second half. Though interestingly, the CFO did say they aren't seeing late bill payments from customers, which of course AT&T was warning about yesterday.
I have to admit, Katie, that was the one from AT&T yesterday that got my attention. Consumers pushing back against paying their bills is an unhealthy sign. Katie, on this show, we don't talk about hard seltzer. It's okay. We'll catch up with you later in about 28 minutes' time. Around the opening bell, with futures recovering a little bit, we're down about 1/10%. Coming up, the ECB ending an era of negative interest rates.
The combined forward guidance that existed for September is no longer applicable. We'll operate month by month and step by step.
And now the ECB facing a monster economic headache. That conversation up next.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain. All members of the Governing Council rallied to the consensus of 50 basis points.
The ECB is hiking into weakness. Eurozone PMI signalling a contraction, dropping to a 17-month low, fueling a rally in European bonds, with German two-year yields potentially heading for their biggest decline since 2008. On top of the story, here's Mike McKee. Morning, Mike.
Morning, John. A lot of fours below the 50 level in those European PMIs. We'll dedicate this segment to Christine Lagarde, who needs all the help she can get at this moment. The Europeans are facing record high inflation, a war, record heat waves, now with wildfires, government collapse, dwindling energy supplies, and now higher interest rates. The only thing we seem to be missing is locusts. You took a look at the numbers there for the PMIs. We'll take a look here at financial conditions and recession odds. Financial conditions had been going up. They dropped a little bit, and now they're headed back up again, tightening again as rates go up. And as rates go up, inflation odds are going up in Europe, 45% now. And we don't have to get to 100% before you get into recession. Usually anything above 38 or so means a recession is getting pretty likely. So keep an eye on that indicator. And inflation, well, the ECB released a new survey today of professional forecasters who say inflation is going to come down, but look at the white line, only to 7.3%. They had thought 6% by the end of the year, and it stays elevated all the way through 2024 and into the longer term. It's going to take a longer time to bring inflation down, and yet this is at a time when the economy there is weakening dramatically. So where does that leave the markets? Well, the WIRP OIS forecast for the European Central Bank has now priced in about between a 25 and 50 basis point move for the next meeting. But after that, they go up a couple more meetings and then flatten out. The question is, do they start going down again too, as people have already priced into the U.S. market, John?
Mike McKee, this is such a tough spot, and Mike, thank you. Looking at euro dollar, the euro weakness we see again. We're off the lows. That's the good news. We're down about 0.4%. The amount of people, and I just go back to that chart that Mike just brought up, that are pushing back against the durability of a rate hiking cycle from the ECB because of the big risk factor on the horizon. What happens with European gas? How investable is this economy if it is totally unforecastable? We caught up with John Hancock's Emily Rowland on Europe a little bit earlier. Here she is.
You've got to be real careful there. You know, growth clearly slowing, earnings estimates are rolling over. We think getting very defensive in Europe, owning quality, embracing areas like utilities, infrastructure, healthcare, staying away, because from an index construction standpoint, if you own Europe, you own cyclicality, you own economic sensitivity, not what you want to own in a recession.
Matt Hornback, just how much more dollar strength is in the pipeline?
Well, John, if you're looking for locusts, you can find plenty of cicadas in the Grand Canyon. I mean, we are looking for the dollar to keep strengthening, John. We think it will definitely peak in the second half of this year, but the second half of this year is quite a long time. We've got 6 months to go. We see the dollar strengthening here, John, both because we think that the Fed being up next week, we think they will possibly deliver an upside surprise to the consensus. But even if they don't, John, the Fed has further to go. So we think that can help support the dollar. And look, global growth, the outlook is just not very good right now. That typically also supports the dollar, John. So we have a little bit more upside in our forecast. We think it will peak later this year.
What kind of number are you thinking about, Matt?
John, on Eurodollar, we're targeting 97 on Eurodollar. And as for dollar yen, John, we do think that you could get some upside above 140 here. So we're expecting another 3-4% on the dollar.
Matt, I did just want to ask you about the reaction function of the ECB. We started the conversation there and you said that we had a decent understanding. So can you help me understand how they would respond to a negative supply shock on the energy side? If gas prices, energy prices started climbing, they were worried about second round effects, even if economic growth was decelerating, would that ECB still hike?
I think the ECB would be front-loading their hikes, John. They may not hike more than they're currently intending to. In other words, the terminal rate for the ECB may not move up, but they may decide to continue this theme of front-loading, which has been a theme beyond just the ECB. Obviously, the Fed, the Bank of Canada, the RBNZ, a lot of central banks are front-loading their rate hikes. They want to move policy to a neutral stance expeditiously, and that's what they're doing.
Jerome, if I was lucky enough to be a PIMCO client and I called you up and I said, Jerome, I'm watching all these European developments. There's this British guy who keeps going on about the bond market and what happens with euro, dollar. What does it mean for the US? What does it mean for the US market? Jerome, what do you tell him?
Well, ultimately, it adds to the volatility and the circular nature of this volatility. I think, we continue to sort of look in the here and now, and it's actually hard to see in the future. In fact, the visibility around the next curve is fairly limited, Jonathan. And so the real practical implication, whether it's a U.S. investor, whether it's a global investor, or even a European investor, is to try to assess what is going to happen, perhaps, but also assess where risks and volatilities might occur. For example, when we think about the ECB, they did a job yesterday, which was to be precisely, clearly unclear. And in that, they gave themselves degrees of flexibility. So when doing that and thinking about that, investors want to maintain those degrees of flexibility as well. It just means sizing your risk appetite a little bit differently in this, as I said before. The half-lives of these consensus expectations can shift pretty dramatically very quickly. And when you think about where inflation is and perhaps the growth, the pivot from inflation to supporting growth by any central bank, those roads could be shorter or actually much, much longer than expected. And so one of the things we were continuing to discount that was actually part of the verbiage not so long ago was the prospect that inflation still had tremendous upside potential and that central banks would have to be inevitably more hawkish. So while we want to think about the growth as being the mechanism why we're seeing the rate rally around the world today, the reality is that it's probably not, it's also perhaps a possibility that you actually might see weaker growth, but rates move higher, especially in the front end as central banks continue to focus on that inflation metric. It all comes down to seasonality for Europe, clearly.
Clearly, a lot of this is totally unforecastable, and I have sympathy with that view. Jerome Schneider, Matt Horn, back to the both of you. Matt, I know you want to take me on a canoe trip, so send me the details. I look forward to it. Coming up, the morning calls in later. BlackRock's Kate Moore, staying cautious on equities for the rest of this year. She joins us around the opening bell. And if you want to check out something to read, Mohamed Al-Arian out this morning on Bloomberg Opinion. Here's the quote. It seems to remain the central bank in advanced countries that is most prone to, using a phrase from former Chancellor of the Exchequer Rishi Sunak, fairy tale economics. And it is the most systemically important of all these central banks. That's Mohamed on the Fed ahead of next week's Fed decision. And I can tell you that Mohamed will be with us live on Bloomberg TV and radio for that Federal Reserve decision. The Fed decides with Bloomberg surveillance. Your morning calls up next.
Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Five minutes away from the opening bell, equities now unchanged and slightly positive on the S&P 500, up by 0.05%. In 20 minutes' time, you get US PMIs. Early this morning, we had PMIs out of Europe, sub 50. Look at this move in the bond market. Two-year yields aggressively lower. Your two-year down 24 basis points. In Germany, your euro just a bit weaker, down 0.5% on euro dollar at 101 and about 80. That's the price action. Here are your morning calls. First up, Morgan Stanley downgrading Micron to underweight, highlighting a challenging macro environment and weakening pricing power. That stock is down by 4%. Next up, Barclays downgrading AT&T to equal weight, $20 price target, expecting quarterly results to revive concerns about management's credibility. We're down there 0.9%. And finally, JP Morgan downgrading Snap to underweight from overweight, cutting its price target to a street low $9 following its disappointing results. Their stock is down by 32%. Honestly, sometimes the stock market is just ridiculous. Coming up, BlackRock's Kate Moore making a case for hedging with cash ahead of a busy week for big tech results. That conversation just around the corner, with equity futures this morning recovering and turning positive going into the cash open. Good morning to you all. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning to you. Closing things out Friday, potentially in positive territory. We reversed some of the losses this morning. We're up by 0.04% on the S&P 500. That's a turnaround. The Nasdaq still softer, lighter, lower, negative, 1/3%. That's the price action. That was your opening bell. Switch up the board and get to the bond market. Yields down, lower by 9 basis points, 278.50 on a 10-year, much lower over in Germany off the back of weaker data out of Europe. For the ECB, I think it was Bank of America that said it's from whatever it takes to whatever. That's what it felt like yesterday. Euro dollar 101.86. We're down 0.4%. Crude, here we go. 95. We're down again by 0.9%. $95 and about 50 cents. 20 seconds in. Let's get you some movers at the opening bell. Here's Kaylee.
Well, John, Snap's getting all the attention this morning, but there's a lot of earnings movers out there, some that are really positive stories, including Schlumberger, the oil servicer. Probably no surprise given that everyone is searching for oil and gas. They're doing pretty well. They beat expectations, actually the highest sequential growth since 2020, and it's raising its full-year forecast amid that expansion in oil and gas. It's up about 8%. You also have HCA, the healthcare operator, hospital operator specifically, up about 17% after topping expectations, and American Express raising its full-year revenue outlook, seeing its best quarter of spending on record, up 30% when it comes to the volumes. Of course, part of that has to do with travel, but also young people, Millennial and Gen Z card members increased their spending by 48%. That stock up about 6.25%. It's a less positive story, though, for Capital One. Earnings missed expectations. Card lending margins were weaker than expected, and they saw a big jump in credit impairment provisions. All that together taking the stock down the better part of 3%, John.
Kelly, thank you. You managed to avoid this one. The joke that is Snapchat. Snap down by 33%. Disappointing results. I guess that's the understatement of the year. Raising concerns ahead of a huge week of tech earnings next week. Apple, Amazon, Microsoft, Alphabet, all on deck. Let's get to Ed and get back to him for more. Hey, Ed.
Yeah, good morning, John. So they missed on the top line and suspended guidance for the current period. But what they said was on a year-on-year basis, revenue is essentially flat, which if you read across the sell-side notes and our Bloomberg intelligence analysis this morning, the inference is that things aren't going to get better anytime soon, given that there's that flat guidance. You look at other social media stocks being dragged down with it, apart from Twitter, which interestingly has kind of pared some of its pre-market loss. It too missed on the top line, but said beyond the macroeconomic headwinds, the advertising market, the uncertainty around Elon Musk's bid to buy the company also contributed to top-line erosion. But holy mackerel, I mean, look at Snap down 34%. Going into this week, we've started to get some buoyancy, some idea that we bottomed out on the NASDAQ 100, and that gave us momentum. But at the same time, there was a lot of reporting that showed big tech, much of which is due to report next week, is not immune to the macroeconomic headwinds that we're seeing across corporate America. Inflation seems to be key, but now we've gone from thinking about future growth to very much about profit. What are these companies going to do, particularly your Apples, your Amazons, your Alphabets, to protect the bottom line in an environment where they're pulling back on hiring, but they're also trying to protect market position? The Apple one's very interesting, that incredible reporting from Mark Gurman, because that's a very conservative move to protect or freeze hiring by Apple standards.
How reliable do you think Snap is as some kind of broader economic indicator? I was just looking at the stock price performance following earnings. Q4 2021 up 59%. Q3 2021 the stock up 27%. Down 27% rather, Ed, this morning. Down 34%. I mean, is this a reliable indicator of anything?
Yeah, so, I mean, they missed their own revision to guidance is one thing. All I can do as a financial journalist is read the transcript of the earnings call and the press release, but that's what I would call throwing the kitchen sink at it, because other than that detail on the ad market decelerating, specifically in the last 90 days, they cite inflation, rising rate environment, uncertainty due to the war in Ukraine. They talk about competition from the likes of TikTok. They talk about changing consumer sentiment. They listed every reason possible why the ad market is weakening and why they missed on the top line, but they didn't have any clear picture of when that would change. What they did say is if you extrapolate out over a 2-4 year period, they've seen big demand for their product. But I mean, I'm not on it. It's hard to know, and part of the narrative around that stock in particular is who's on Snap, just as we had that same discussion around who's on Facebook anymore over the last 18 months.
Kelly Lyons is, and I still don't know what Pinterest is. I've never even been on the website, never mind downloaded the app. Kelly Lyons has got some kind of Snapchat run going, and I don't know what any of it means. Kelly, I'm sure they've turned your mic up now. Do you want to tell me what you do on Snapchat?
It's a snap streak. So
It's
if
a
you
snap
snap
streak.
someone every day, you get a little flame emoji.
How many
Mine's
days?
1,704 days. Not to
1,700,
brag.
and that's with the husband?
Yes.
Okay. All right, Kelly, thanks for that. And Kelly, thanks for your work this week on surveillance. We loved having you. Thank you very much. BlackRock's Kate Moore has got this to say. I don't know. We don't expect earnings to generate a reversal in weak investor sentiment, even as an increasingly large number of quality high-growth companies look to be attractively priced. Kate, I'm pleased to say, joins us now. Kate, I'm not going to ask you whether you're on Snap. I'm going to ask you this. What do you make of this bounce in the equity market over the last few weeks?
Yeah, so let me just say this. We still are at the very beginning parts of the earnings season. So we know that there's a lot of kind of sentiment work through as companies report and share their guidance and divine as much as they can the future. At this point, I would say the snap, I don't want to use the word snap, but the snap this week in equity markets has really been more of a reaction to incredibly bombed out sentiment. It's not, a reaction in the market that is built on a huge amount of participation or a huge amount of enthusiasm. I would just say that everyone had become so bearish. The economic data is very mixed, but not universally negative. And I think there was some room, particularly from some of the systematic players and things, for a little support in the market near term. That said, I think as you saw from that quote, we are not taking a huge amount of incremental risk right now in the equity market.
Where do you think this leaves the Fed, Kate? I asked that question because the objective was to tighten financial conditions. What we've seen is a loosening of financial conditions, and I wonder if that easing of financial conditions in their eyes is an unwarranted one. Would you agree with that?
Well, look, pre this last weakening of financial conditions, we had, say, a much tighter environment. And I think that we thought, like a lot of the work of the Fed had been done by tightening financial conditions. At this point, we think the inflation and the broader economic data all suggest the Fed needs to really stay on track. We're in the 75 basis points camp. But we do expect by the end of this year, more of a signal, not necessarily forward guidance, but more of a signal that the Fed is going to take its foot off of the brake when it comes to raising interest rates. It's not the end of the world if we get to a significantly higher policy rate environment. We're just readjusting both in terms of valuations and expectations as we go into the back half of this year. And frankly, if the Fed had taken their foot off the brake sooner rather than later, given the kind of spicy inflation prints we've had more recently, that would be a little concerning for us.
Well, Kate, this market seems to be playing a slower growth theme already. It's transitioned from the inflation story of the first half to a slower growth theme as we get into the second half. I see that in the bond market today with 10-year yields down and 2-year yields down more. Your 2-year down 10 basis points. You see it in break-evens, the inflation story rolling over. Do you think it's too early to move your allocation away from the inflation winners, the energy beneficiaries, over towards, say, the recession plays, the slower growth story?
Yeah, it's a good question, John. Just something I want to kind of point out, and it's been on my mind a lot because we've seen this data come out from a lot of corporate surveys and, of course, the Richmond Fed Duke Fuqua survey, which came out at the end of June. There's this massive disconnect in sentiment for corporates between what they see as strength in their own business and the concerns they have for the U.S. economy. So this divergence that we've seen in terms of, hey, things are great on the ground with my business, we think we have some visibility, versus we're worried about broader cracks in the economy, may lead to kind of a slower growth environment sooner rather than later, as in companies may decide to pull back capital expenditure and investment or delay a little bit. We've certainly heard a lot of companies delay in terms of hiring plans. Some of that's smart. If we're in a slower growth environment, you want companies to batten down the hatches a little bit to streamline their businesses. That said, we're not seeing a significant pickup in CapEx investment, as you mentioned, kind of in the energy and resources space at this point. While some of these companies, early reporters, have indicated, slightly higher costs, whether it's on labor or other inputs, in general, we think the supply-demand balance in the commodity space, even with slightly slower growth, looks quite attractive. And we wouldn't be backing away at this point from some of our resource plays, which is a core part of our portfolio at this point.
It's okay, you stick with the energy players, stateside specifically. specifically?
Yeah, we like energy, and we continue to really like a bunch of the resources in terms of industrial metals and kind of miners. And we think that the agricultural complex still has room to perform.
How do you play the ag complex?
Yeah, there's a lot of different ways to invest in the ag complex. I mean, I think I favor a more diversified approach where you look at seeds, fertilizers, crop protection, and agricultural equipment. I like that diversified basket so that you are playing all parts of the cycle, understanding that in different parts of the year and different parts of the growing season, some companies will have better performance than others.
Okay, can you help me with your exposure to the consumer? There's been this talk about this rotation from goods to services. You've talked about it for a while. How do you want to play that theme?
Yeah, I would say it's a little bit more nuanced, John, than when we first started talking about this rotation from goods to services. Because right now, we want to be more focused, too, on consumers that are less sensitive to rising input costs, which means that in addition to services, perhaps services and some goods that cater more towards higher-end consumers and upper-income cohorts. We've seen some of these stocks perform quite well. I expect we'll continue to see strong earnings from them in the second quarter and solid guidance. But some companies that are really focused on the low-end consumer or who are playing in more commoditized markets, who don't have the ability to pass on higher prices, at least not now, we think will be a little bit more challenged. So it's a nuanced story within consumer. Some goods to the high end still look attractive, but in general, we like the services play.
Okay, where does the telecom companies fit into that? Because AT&T, Katie and I were talking about that this morning, and yesterday, going through those numbers, to hear that a company is facing consumers that are putting off paying their bills, Kate, is concerning. I just wonder where that leaves you.
Yeah, it's an absolutely challenging and sort of troubling piece of data. And I think we'd want to hear from more companies across a variety of different industries that was the experience they're having with many consumers. But this is something that's definitely raising a flag. And we want to, really monitor a lot of the credit card data. You were talking just before I came on about some different experiences that banks and financial services are having in terms of their credit card data, whether or not low-end consumers are putting more on credit card, whether or not people are delaying paying down their full balances. I think that's also going to be an important high-frequency bit of data for us to monitor as we figure out really the strength of the consumer in the second half.
Okay, final question, and perhaps the most important one. You've maintained a lot of dry powder through this year. You've told me that repeatedly as we've caught up regularly. I just wonder what you're waiting for. What's the inflection point that you're looking for, Kate, to start to deploy that more aggressively?
I mean, John, I really want to be excited about deploying some of this dry powder. At this point, I think there are a few things. Number one, we want confirmation that the inflation data is rolling over, not just 1 month, but a kind of a sustained few months, which I think is also going to be incredibly important for the Fed. We're not expecting big forward guidance from the Fed. I think we know that's off the table in the near term, but some sort of softening in language that perhaps they can decelerate the pace of rate hikes. The second thing, I think, is really around geopolitics. We're really interested and concerned, frankly, around what energy supply into Europe might look like going into the winter. We also really want to pay very close attention to the sort of the new data in terms of Chinese growth, and not just before, but certainly after the Party Congress, and whether or not consumers feel more confident there. So there's kind of a global growth geopolitics, a bit of data that we're watching. And finally, I just want to get through this earnings season and see where companies feel that they have the best confidence in their future growth. Because right now it feels like everyone's very uncertain.
Next week is a big week for earnings, that's for sure. Kate Moore of BlackRock. Kate, thank you. It's great to catch up. A Fed decision next week as well. We're looking at a 2-year yield with a break below 3% in America on a treasury, a 2-year treasury. Over in Bundland, over in Germany, the Bund market looks like this. We're down 20 basis points on a 10-year in Germany, down 21 on a 2-year. This came from Michael Harnett of Bank of America, just as we break through 4K on the S&P 500, if you want to think about a level from him. Buy now, pay later, the theme from B of A. He said, buy now, and then he used this quote, the only time you've ever seen this level of pessimism and not made money being contrarian long was Lehman. And then he said, pay later. Peak CPI, peak yields, Fed done by 23, unlikely without a big recession and or a big credit event. He's saying sell SPX of 4,200. Something to think about as we just break through 4K on the S&P. Coming up, recession, looking like the price to pay to beat inflation.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here. Evidence of that over the past few days with economic data In the U.S.,
That conversation up next, and some US PMIs in the mix as well.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global economic growth is decelerating at a pretty rapid clip here. Evidence of that over the past few days with economic data. In the U.S., initial claims rising. We saw the Philly Fed just plunging. We're seeing the leading economic indicators barely hanging on at 1% year-over-year growth. We see this broad environment where economic growth is slowing.
That was Emily Rowland of John Hancock Investment. Economic growth is slowing. Massive downside surprise on European PMIs. I can tell you the US following suit. We've got a big move at the front end of the curve in America. Your two-year yield is down 18 basis points to 290. It's a big downside surprise on the US PMIs. Let's get to Mike McKee for more. Morning, Mike.
Well, misery loves company, John, it appears. The European numbers were terrible this morning. The U.S. numbers are terrible, too. The S&P Global PMI numbers have always been sort of a tertiary index, but we're following them closely these days for progress on the economy. And the manufacturing PMI falls to 52.3 from 52.7. Not bad, but then take a look at what happens with services and the composite. They fall off a cliff, both in contraction territory. Services down to 47 from 52.7. And the composite down to 47.5 from 52.3. Absolutely dismal numbers. And if you're making a bet on recession, this is why the 2-year is going down. The only country, John, that had relatively decent PMI numbers today was the United Kingdom. They're all still in the 50s. I don't know what you guys are doing, right? But at this
Not
point,
much at the moment, Mike.
At this
not
point,
much.
you're tied with the Europeans for the highest recession odds. The U.S. at 40%, but we'll see if those numbers change over the course of the next day or so. Well, into next week when we're trading again, because at this point, the numbers are certainly arguing against major rate moves maybe after next week.
Mike, what do you make of that services print? That's just a monster of a downside surprise. 47 handle.
Yeah, I haven't seen the details. My guess is maybe what is happening. These are, we compare month to month, and the PMI purchasing manager asks how they think of this month compared to last month. We may have hit like peak summer. So airlines, travel-related people are saying, well, you know, we've now sold the tickets for the rest of the summer, and so August isn't going to be as good as July and June in terms of new business. That's my guess. It also could be the heat wave. Maybe people don't want to go out too much.
Your assessment of the Fed next week, Mike? Are we going to get a story in the Wall Street Journal Monday morning that says 50 and not 75?
You know, if this were the PMIs from the ISM, I would say that's a possibility. I think because it's the S&P Global one, it's a little bit smaller companies that they'll stick with 75. But Nick may be sitting by his phone. Nick Timrose may be sitting by his phone this weekend. I still would think they're kind of locked into 75.
And 2-year yields are down aggressively, and Mike, thank you. So we got a 47.5 on the composite. This following a big downside surprise in Europe that dragged bund yields lower. Now we're seeing the same in America, dragging 2-year yields even lower on treasuries. We're down 18 basis points. I want to get to Kaylee for more on the price action. That was a surprise, Kaylee.
Yeah, a big one, and the bond market reacting as a result. The 2-year's down 18 basis points, the 10-year by 14, so you're actually getting a little bit of a steeper yield curve right now. But the reaction in the dollar, John, also really notable. The dollar at session lows, the euro at session highs, now actually flat against the U.S. dollar. And when you put the move together we have seen this week for the dollar index, it's the worst one going back to February, John. I think that is really remarkable. But as we talk about a rotation in the economy from goods to services, what is happening in that services industry? I was just checking to see if restaurants or airline stocks were reacting to this. Not much, but if this is a story that continues, you may start to see that show up.
Unbelievable, Kaylee, and thank you for that. If you missed the European numbers, we also had a sub-50 composite PMI there too, but the data in America actually worse, believe it or not. Your equity market stays elevated, up 0.25% on the S&P 500, on the Nasdaq up by 0.2%. This data coming out ahead of the Fed decision next week as we look potentially for a 75 basis point rate hike. That's dragging your 2-year yield lower though. Over in the United States, your 2-year much, much slower off the back of this data, and your 2-year in Germany down 26 basis points now, basically, to 36 basis points on a 2-year. On a 10-year, down 22 over there. Sub 1% 10-year yield over in Germany. And we had the headline earlier. If we close around these levels, this is one of the biggest one-day declines on a 2-year yield out of Germany, going all the way back to 2008. This is what people worried about. It's only one data point, of course, and we'll look for more, but the worry was that this Fed would have to confront inflation and hike interest rates into economic weakness. And we're seeing some of that weakness on both sides of the Atlantic this morning, with weak PMIs out of Europe and now weak PMIs out of the United States. We're down big time at the front end in Germany. Your 2-year yield aggressively lower. Coming up, the market moving stories you need to be watching over the next week. Your trading diary is up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market all over the place, 25 minutes into the session. That's the equity story. I just want to take a snapshot of the bond market picture. I did not expect to see that print on services PMI. Did not expect it to be that bad. The move at the front end there for all to see. We're down about 14 basis points on a 2-year yield. That's the price action. Here's your trading diary. The White House press secretary speaking at 3 Eastern. Looking ahead to next week, tech earnings continue with Alphabet and Microsoft on Tuesday. The main event on Wednesday, a Fed rate decision and Chairman Powell news conference. GDP and initial jobless claims on Thursday, followed by more tech results with earnings from Apple and Amazon. Looking at your equity market right now, about 26 minutes in, we're just about negative on the S&P and we are lower by 0.4% on the NASDAQ. Big week ahead for earnings and the Federal Reserve. Looking forward to covering that with you. This was the countdown to the open for our audience worldwide. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in prize sourced every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man named only as